Hello, good afternoon, Harsh sir. Am I audible, sir, to you?
Yes, yes, please. Yes, yes.
Great, great, sir. So just give us a couple of minutes time and we'll start.
All right. Thank you. Thank you, Parik. Thank you.
Yeah, thanks a lot, sir. Thank you. So hello everyone. This is Deepak Parik. I'm managing partner at HnyB Tech Incubation, a niche consulting company which works on intersection of agriculture and technology, working very closely with different ecosystem players. Today again, we take pleasure in welcoming all of you to this session of Agriculture Roundtable. Today's our topic is a very pertinent topic. It's about agriculture finance. We have seen, especially during COVID times, that if there is one sector across the developing countries, whether you talk about Nigeria, Ethiopia, Ghana, Indonesia, Vietnam, India, the upward movement of credit pickup has happened only in this sector. While sector like industry and service, the credit uptake has either gone to the negative territory or has reduced substantially, it is agriculture where the credit is still required, is being taken up. One of the reasons is that because food is hope. We all need to have food on our table, irrespective of whether we are going through a pandemic like COVID or overall. We all understand that various research has time and again shown the emphasis that how much important or critical the agriculture finance is. According to the Food and Agriculture Organization, non-availability of credit is one of the biggest reasons for low productivity in developing countries. Depending on which country you pick up, it varies from 8% to 20%. We all understand that a farmer needs money at the right time. He's just like in a startup. Twice or three times in a year, he starts from the scratch, buys input, put all the hard labor, and then wait for various parameters to be favorable to come out with the harvest. At each stage, he will need access to finance. Unfortunately, we are seeing time and again in developing countries that agriculture finance is not something which organized financial institutions are very keen to uptake, which is very evident even from the data. Whether we see data of India or Vietnam or Indonesia, and all the way to Nigeria, you'll find the agriculture is contributing substantially in employment generation, but credit to agriculture sector is pretty low. In some countries, it is 8%, and country like India, out of total 1 crore rupees worth of total credit outstanding, agriculture is just around 12.8 lakh crores. That itself shows that actually how neglected this area has been. And today we are having some of the most experienced, knowledgeable, eminent guests who will be speaking about the challenge of financing agriculture. The focus is definitely developing countries. Closer home, definitely India. While we do have our audience from all across the globe, they have been with us for previous 4 roundtables as well, which was on irrigation, digital agriculture, input management, policy and investment. And today, we'll be talking about agriculture finance. Now, without taking too much of time between me and our eminent panel, let me introduce our first speaker. And it's an honor to have Dr. Bhanwala to be speaker for a very simple reason that actually he's, I would say, an institution in himself. The body of work he has done is just outstanding. Whenever I've heard about in various conferences where he was speaker, and I had opportunity to be physically there rather than today what we are doing virtually, and it was mesmerizing the knowledge he puts on the table. So Dr. Bhanwala doesn't need introduction, but I'll go ahead and still do that. Is the executive chairman of Capital India Finance Limited, an India-focused integrated financial service company since August 2020. He is an independent director on the board of Bayer Crop Science India Limited and senior advisor to Omnivore, which is a venture capital institution. Prior to joining Capital India Finance Limited, he was the chairman of National Bank of Agriculture and Rural Development, generally spoken as NABARD. He recently headed the technical group appointed by SEBI on the Social Stock Exchange. He has vast experience of more than 36 years in development finance, organizational transformation, and solving rural problems by enhancing farmers' income and promoting sustainable agriculture. He has been the executive director and later the chairman cum managing director of Infrastructure Finance Company Limited. Floor is yours, sir.
Thank you. I need to be allowed. I'm not able to start my video.
Yes.
Not allowing.
The host has stopped it.
So can you start your video now? I think it should be.
Yeah, now it's done. Thank you.
Right.
Thank
Yeah,
you.
I'm so sorry, sir. Yeah, please.
First of all, thank you, Deepak Parekh Saab. It's a pleasure to be here, and I'm delighted to be with you. And I'm thankful to you for inviting me for this interaction with the people across the globe. And at the outset, let me say that Agriculture finance is a very interesting subject for developing economy. And even for particularly for a economy which is about to be developed, it's quite interesting. Primarily because of the fact that number of people who depend on it is sizable, even if the economy develops to a large extent. Because the shift in population takes time. Secondly, in most of the developing countries, the contribution of agriculture continues to be high in the GDP as well. If you look at when India got independence, more than 50% was the contribution of agriculture, though it has come down to around 13-14% today. It's the same way in many of the other developing countries as well. So the impact that it has in terms of number of people who need to be participating in sustainable development goals and sustainability efforts of the world, I think the sheer size makes it a very important subject. And the entire agri input industry is hugely dependent on agriculture finance, because you got to monetize. Today's economy is not a barter economy. It's a monetized economy. So the extent of monetization, and let me also say in today's world, extent of digital monetization, which I'll address later, drives the economies in a different fashion altogether. Agriculture, when I say, it just doesn't have only the farmer at its focus. I have farming requirements with the farmer as a centerpiece, but off-farm investments required, off-farm supply of inputs, seeds, etc., mechanized services, and also irrigation requirements, as also downstream investments in reaching out to the markets. Today, particularly in a country like India, which is a developing country, and others can also learn from it, we have done quite a bit in terms of production. Although somebody can say that productivity is still a challenge and it requires more intensive agriculture and more precise agriculture, which would have its own requirements of finance. But at the same time, let me say that focus is today on reaching out to the markets the way the consumer wants the products from agriculture side. We have seen in recent times, in various areas, veganism taking the centerpiece. We are having even mock meats, various items of which are protein-based items, which are coming from vegetation, and which are otherwise similar to the meat industry products. So all this gamut, not only just finance, risk mitigation initiatives by various governments and by the farmers themselves, like the insurance products, guarantees, and then various types of grants being passed on by state governments, they all come into the fold of what you can call the agriculture finance to some extent. On-farm is one part, off-farm is another part. Short-term requirements for productive purposes is one part, and the investment requirements are another part. And in addition, I would say a third component is also the minor consumption requirements of the farmers, which are very, very important. At this juncture, since most of the developing countries, rural areas is where the agriculture lies, unlike some of the Western countries where urban agriculture is getting a focus, we are primarily in rural areas. And once we talk about rural areas, then we can, and agriculture being the main activity, we cannot look at agriculture in isolation. I think we have to look at the entire rural development effort along with agriculture development and also its financial requirements which go hand in hand. For instance, if you're constructing a road, it pushes up the agriculture infrastructure, but at the same time, it gives benefit to so many other economic activities, schooling, health, etc., etc. So I don't know. We need significant amount of effort for building agriculture infrastructure and also the rural infrastructure in harmony to ensure that investments in agriculture take place and benefit the rural people in coming up above the poverty line. If you look at the divergence between the urban poverty and the rural poverty, you would see still in developing countries, there's a large number of rural poverty, which is higher than the urban poverty. So with agriculture being the main focus, I think if we would take them off poverty line, out of the poverty, then agriculture activities and activities around agriculture are going to be playing a significant role in mitigating their the issues, the challenges they face. This becomes all the more important when we have climate change like issues. You know, who gets the worst when it is climate change? It is the poor. And it is where the infrastructure deficit is the highest. So rural areas and the poor people need to be looked after, specifically when we are focusing on climate change. And we have seen small interventions in a state like Orissa, which is facing regularly the cyclones, etc., on a yearly basis. We have seen the relief measures, constructions, etc., in terms of rehabilitation centers, etc., goes a long way. And in certain other states also, we have seen flood irrigation, flood protection, embankments, etc., on the sea, breakers for the sea waves, etc. To some extent, plantations on the sea, the biodiversity within the sea zones, etc. They significantly impact the environment in a particular area, and to some extent, they also have impact on agriculture, production systems of the surrounding areas. We have also seen in recent times, the world over, the food habits are changing. With the rising income levels, we are seeing increase in protein requirements. And especially we have seen in last decade or so, although not as much, but again, seeing an uprise, commodity prices for certain protein-based products and oilseed-based products have gone up. And I think this commercial orientation of agriculture is also throwing up new opportunities for agriculture finance. So as long as it was a subsistence agriculture, local consumption, the digitization was not as much there. As such, monetization was not high. So agriculture finance was not as robustly planned and as to a large scale as is being planned now. Although agriculture finance has deep roots, quite since earlier days it has been there. Now, if you look at in recent times, the entire sectoral needs are undergoing small changes on account of commercialization of agriculture. We are seeing newer players coming up. They have working capital requirements. They have newer value chains coming up. We are having the many startups offering services, which again require monetary support. And they require a different kind of support. Earlier, it used to be just debt part to some extent. Larger portion was coming from debt. Today, we require different versions of capital, which is maybe equity, which may be subordinate debt, which may be initial seed funding, grants, etc. And many of the places we have seen agriculture sector is subsidized sector to some extent. And so the grants also form an important part. In certain countries, guarantees play an important part. And we are seeing when I was chairman of the NABARD, we have seen the guarantees playing an important role for giving a fillip to the kind of agri-finance, which is the requirement of some of the FPOs, farmers producers organizations. Because we have seen, when the small holdings are there and they're scattered across the country or the region, then they need to come together to access for services, to access to the market, and also to ameliorate their own things, and also to reach economies of scale. So for that purpose, FPOs, cooperative societies in past will continue to play an important role, along with certain other reforms initiated by various governments across the globe. Now, in such a scenario, guarantees will play, equities will play. And so we will see newer form of agriculture finance in times to come, rather than just simplified debt version, which has been there in the past. From India's point of view, let me say that, agriculture finance has come up in a large way. In 1950s, just 16%, in 1980s, let me say, not 50s, just 16% of agri finance, 16% of agri GDP was the agri finance. Whereas this has now jumped to 51%. So which means more of monetization of these things, and also the larger requirements across the value chains, and the deepening of value chains in terms of the services they offer and the requirement of the people. We have also seen, and there are across the globe, it is there, that agriculture finance in certain regions is available is in plenty. In certain regions, it is not so abundantly available. Within India, we are seeing Northeast, Central India, and Eastern region of the country requiring more credit flow than is available. For instance, the gross cultivated areas in these regions is around 44%, whereas the credit flow is only 24%. So similarly, in various other developing countries, there are pockets of agriculture affluence who draw more of finance, but we need to focus on certain other areas which hold potential. For instance, Central India is contributing significantly to agri production today in the country. East is potential to contribute. Northeast is potential to contribute significantly to the horticulture production. So that's another point. Third point, next point I would like to mention is horticulture crops will be more in focus in times to come. And they require not just working capital, they'll require investments on the farm also. And not only just plantation, but precision farming to enhance the irrigation efficiency, as also maybe some artificial environment for cultivating them in certain hardship areas where the temperatures are very, very low, so glass houses, etc. So we would require modern means to do precise agriculture, because sustainability is going to be a bigger challenge to come in the times to come. We have to focus on what resources are we using to produce what we are producing today, and how much can we save it for the future. So this will provide future dimension to agriculture finance in a significantly different manner than what it has been in the past. We have had two very good initiatives in India. Over the years, number of initiatives. We have diversified entities, multi-agency approach we have. We provide more than $200 billion of agriculture finance, probably one of the highest in the world. Every year, the banks disburse, various types of banks. But the proportion of investment credit has been enhancing in the recent times, which means the larger investments on agri farms will enhance productivity in the times to come. Will also enhance the efficiency in terms of market outreach, because 2016-17 RBI changed the definition of priority sector, and the investment credit, which may not be exactly on form, has got an impetus on that count. So various other countries would also have their own mechanism to ensure, like the priority sector mandation is there in India, they have some mechanism or the other for ensuring that the credit flow to agriculture goes on. Now, we have also had, there have been fluctuations in prices, etc., and the holdings are small in many countries, especially in India. And many other developing countries also where the density of population is high. Now, in such a scenario, when the incomes are small, then probably some way to enhance those incomes are there of the farmer. We have had very good initiative in recent past in India, Krishi Samman Nidhi. I mean, the farmers are, small farmers in particularly are paid, made some transfer payments every quarter and a particular year. The amount could vary from state to state, but there is something from the federal government which comes up. So that's a good initiative. But this also throws up the challenge that can these farmers afford high interest rates? Probably the challenge is many of them are not able to afford the high interest rates because sometimes the commodity prices get subdued and the size of the farm is not as high, as big. So which requires interest subvention opportunities also. And one very interesting thing development in, I mean, almost 2-3 days ago is, and also some years ago, is the digital initiative for transferring payments to farmers, which will stop leakages and will bring robustness to agri-finance. And this 3-4 days, almost a week ago, Indian government has announced e-rupee as a new initiative. I think that's a very good initiative because we are transferring the amount to an individual without any hiccups, without any smartphone, to a and for a specific purpose. For instance, he is to buy fertilizer, then this QR code which is getting transferred would only be paid only at a farmer's fertilizer shop at no other place. So these new digital initiatives finance evolving around agriculture, digital agriculture. I think this holds a lot of scope. We have seen in India an average growth of around 11% in agriculture finance in recent years. And the requirement of short-term credit has been around 5 almost 6%. So the growth is more in investment terms. That's commercial nature of the organization, commercial nature of the agriculture, as also the deficit of infrastructure in rural areas and for agriculture, which is there. More and more of investment would be required in rural areas to ensure that this goes on. Small farmers will need to be focused. In most of the developing countries, as also in India, the landowners, many of them move to urban areas, so they have tenant farms. So another aspect of agriculture finance is we have to have mechanisms to ensure that these tenants get covered because their financial requirements are very, very important. Small and marginal farmers' requirements need to be specially prioritized. So we have mechanisms like formation of joint liability groups, self-help groups, etc., where outreach is created to these entities. Also, some areas, some loaning certificates have been tried, loan eligibility certificates. So those could be tried to ensure that they are financially included all the time. And I'm a simple person. I'm from a rural area. I'm from farmer's son. I know if the GDP has to be enhanced, let's say for India, $5 trillion, or maybe for other countries, whatever the benchmark, then the best thing is that everybody contributes in a larger way, which means everybody is financially included, which means everybody is financially included in an efficient manner. So which means IT. I think we are seeing a good IT play through our startups. I see in next 2 or 3 years, at least 2 or 3 unicorns in agriculture sector to come up within India, maybe across other developing countries also. I'm closely working with some of them. You know, they start from the good assaying of agriculture production from satellite drones, etc. So once that is done, then they link to the banks. It becomes crop specific. You can do a better commodity planning. The good focus on the quality. There are startups like Agnest and others. They're working on within Agnest in Indian context, and some others maybe at some other place. They pass on the quality of the produce much ahead of the harvesting, and especially for commercial crops, it becomes very, very important. And if the market is at a distant place, so you can reach to a different place. Building of value chains, advisory services through startups. I think this is going to be transforming Indian agriculture. Also, I've seen mechanized services being offered by some of the startups. Some of the new, deviating kind of things which were earlier highly labor intensive, and criticality of availability of labor is very, very important in agriculture. If it's not at that time, then it's not there at all. So whatever finance you put. So in such a scenario, I think the mechanized services will play an important role. And mechanized harvesting services, we have seen they avoid losses to the farmers in a big way. So if we can invest in those areas, it will go a long way. And this will hold future, targeted finance available to the targeted person, to the targeted segment, and to a targeted marketing, and with quality insurance, and in the form in which the consumer wants. This is what is the future agriculture today. I think this kind of transformation is really important, and agriculture finance will have to be accordingly reoriented. Let me say that we have to also bring a sustainability angle, and many of the startups are working on this to Indian agriculture, or to developing to agriculture of developing countries across the globe. Because if you consume large amount of water, if you degrade the soil health, then you are jeopardizing the future for the future generations of the primary agriculture use. I think this will hold a good thing. Focus is going to be on horticulture, protein-based products like milk, again eggs, fisheries. There's hold potential. Then some of the bio innovations, along with mechanized services innovation, will certainly come up through some of the startups, and they have potential for huge growth. And some of the existing players are also buying these startups factories. And I think warehousing will play a great role. We already have within the country, we are planning Agri infra fund of 1 lakh crores, or let me say that huge amount in couple of years to come. So if the large scale value degradation that happens on account of delay in procurement and appropriate storing conditions, that can be avoided. And we still have large hunger across the country, across the globe. So if we are able to save 3 to 5% of whatever gets spoiled, the field itself, then that can be adding significantly to our human resource development across the globe. Climate dimension, I've already said. Viability of holdings is another area which we'll need to focus on. Let me also say that IT will transform agriculture. And similarly, IT will transform agri-finance as well. And we will have, somebody saying productivity of rupee going to agriculture finance has been questioned by some of the economists in the past. But, you are producing for the country with even 16% of the GDP value, even at 51%, you would say. Or so productivity is at times questioned, which is sometimes I don't fully agree. I'm not agreeing with that concept at all. But this specificity through IT interventions of flowing money for a specific purpose, for a specific intervention, for a specific crop in a specific region, during a specific season, creating fallback mechanisms for risk aversion, etc., will certainly improve the efficiency of every rupee being invested through agriculture finance. I think I am on time. I will not go more. Parik Saab, from my side, but huge deficit in infra will have to be brought in. And for that, I would suggest that private sector may not have the user charges availability coming from agriculture sector so easily. So for that purpose, either it will have to be a viability gap funding with the state governments, or it will have to be developed by the state governments or the governments, federal governments. But the property that get created, the assets that get created, can be made available to the agri entrepreneurs to man them, to take it on lease, operate them for the benefit of the farmers, and pass it on to the original. And this also is required because buying land for creating assets is getting more and more difficult for private players. So in agriculture infrastructure developments, it is not going to be just viability gap funding by the government. I think governments will have to be more proactive in supporting agri infrastructure so that the private sector can also come and contribute. Otherwise, in the absence of such a large requirement for agri infra, there'll be a delayed response for agriculture development in certain pockets and in certain regions, as also the flow of agri finance will be subdued. I think with this, I thank you for giving this opportunity. And I really look forward to if there are any questions subsequently as per your calendar. But I feel agriculture finance holds a huge potential for innovations, which are going to be IT based and which will be for the benefit of the farmers and for the benefit of sustainability, and which will cater to not only sustainability, but also environmental issues.
So thanks a lot. It was an honor to have you. And in fact, you have nailed it perfectly. I interact with a lot of multilateral agencies to the startups across the globe, and the credit rating through data, blockchain for efficient financing, cross-border trade financing through blockchain-based ledgers. All these things we are seeing that is going to reduce substantially the cost of the financing, just because of even just like agriculture, sometimes developing countries also have financial sector also not very efficient when it comes to the cost of financing. So as you rightly said, that IT is going to play a very vital role. So thanks a lot, and it was a pleasure to have you on our roundtable, sir. Thank you.
Thank you. I love being here.
Yes, sure. So now let's go from one stalwart to another, and our next speaker is Mr. Arindom Datta. Mr. Arindom is Executive Director and Head of Rural and Development Banking Advisory at Rabobank. He has been working for Rabobank for the last 15 years and has over 28 years of experience in rural finance, cooperative, microfinance, and agribusiness banking. He is responsible for sustainability, banking, initiatives of knowledge, risk management, and business development. He also oversees the development finance project in blended finance, technology innovation, and access to finance in agriculture sector. He's further passionate about following the agtech development and its significance for smallholder farmers. Floor is yours, sir.
Thank you so much, Deepak. It's a pleasure to be here, and it was a pleasure to hear Dr. Bhanwala. He gave a very comprehensive presentation, and I'm sorry there will be some overlap with whatever he said because it was so comprehensive. So I'd like to break my presentation into 4 parts. The first part would be the problem statement. Let me go straight there. Now, I will talk specifically of farmer financing because it's an issue of fragmentation in the Indian market. And because of the fragmentation, all the issues and challenges we have in financing, that gets transferred to midstream and downstream also. I'll not dwell on that much. But in India, we have approximately 140 million farmers, of which 126 million are small or marginal. That's a huge number spread over a large geography. Now, from a credit perspective, from a banking perspective, data is key. How does a retail financing bank get the right kind of data to be able to take decisions that makes it possible for the banks to build up a healthy portfolio? Now, there are 2 costs which play on each other. The first is the transaction cost, extremely important. the more data you need to gather. In a traditional farmer financing model, the transaction cost shoots up because you need to invest in branches, in people, to have your rural network, etc., which at times makes the portfolio, the agriculture portfolio, unviable. And if you don't invest there, then the risk cost goes up and you land up with losses in your portfolio. So it's a catch-22 situation for the financing institutions so far in the traditional mode of banking. Is either I invest, if I invest, my costs go up. If I don't invest, my losses go up. And that has been the biggest reason for the hesitancy of the Indian financing institutions to do farmer financing. In short, the first big problem is one of information asymmetry. And information asymmetry not only hits the banking sector, but the smallholder farmer, whether it's his or her access to finance, access to inputs, advisory, infrastructure, markets, you name it. It's the information asymmetry is the biggest pain for a lot of issues, specifically financing. Now, that's the first problem. The second problem is in India, when we talk of banking services, financial services, we invariably talk about loans and debt services. How do we push loans to the farmers, whether it's for balance sheet financing, whether it's crop loans or investment credit to build up infrastructure, or it's post-harvest loans, where a loan is given against the surplus that the farmer wishes to store. However, the not real emphasis has been given to risk mitigant financial instruments. Now, crop insurance products in India have not been effective, not been efficient, and has not worked in the Indian context. It has not worked in most parts of the world. So that's one big challenge for the financing system, for the banking system. And second is, to protect the farmers from the market risk and the price risk, we do not have evolved financial instruments that the farmers or farmer organizations can participate in. It's still very, very nascent. Now, because these protections are not there, the risk gets transferred either to the farmer, the weakest entity in the value chain, or the risk gets transferred to the financial institution. So this, in broad, is the biggest problem, the one of lack of financial instruments that act as risk mitigant and information asymmetry. Now, from a policy perspective, whether it's the government of India, it's the RBI, the kind of innovations that's happened in India is unmatched. It's not happened anywhere else in the world. If you look at the setting up of the cooperative banking structure, the regional rural bank, setting up of NABARD itself, or the MFI transformation, the SHG, financing that has happened in India, the small finance bank, the priority sector norm, there's been a huge policy push. But then across decades, financing remains a problem. And as per the data I have, that farmer financing has in real times shrunk over the last few decades. Now, in real terms. Now, what is the future? Is it all gloom and doom? It's not. There are two developments going on in the Indian market. The first one is the physical aggregation of the farmers into FPOs. Now, once we have FPOs and we have, kind of more matured FPOs, it makes it a lot easier for business players, whether they are input players, whether they are output players, or they are financing institutions, to be able to reach out to these aggregation of farmers or to the underlying farmers in a more meaningful way, because they have access to better data. Farmers are organized in a better manner. So that's one big revolution that's going on in the Indian market. And the second one, more critical, that's something, Deepak, you referred to and Dr. Bhanwala referred to, is technology. Modern technology, whether we talk of machine learning, whether we talk of artificial intelligence, IoT, drone, satellite, blockchain, and more importantly, it's the kind of human resources which has got into agriculture. The finest of human talent, which never got attracted to agriculture, is now getting into agriculture because they love technology and they love big problem statements, and agriculture gives them a big problem statement. So we have more than 1,000, startups or agtech, fintech companies in the market today, and it's being backed by private capital. They are not getting subsidized. So that's one big hope for the Indian agriculture sector. Now, what is it that they do? Now, technology helps to virtually aggregate the farmers in a meaningful way and to engage them with market players, including financial institutions. Most importantly, financial institutions require static data. When I say static data, it's about the land, about the farmer, but it also requires dynamic data. That is about the different crops, the crop seasons of what's being grown, what the productivity levels are at, what price they've been sold, what's the quality of the produce. Now, that's critical data that a bank or a financing institution needs to know. And technology today enables for all that. Now, there are agtech companies, there are fintech companies, there are technology-led NBFCs. Just to give you a few examples of pure fintech, Jai Kisan, Dwara e-registries, etc. On the post-harvest front, which is again underserved in the Indian market, we have ARIA Collateral, Argos now, all backed by private capital, doing great work in providing financing for smallholder farmers who have small lots of excesses, and through a virtual network, they are linking up financing institutions to the surpluses so that funding happens to the farmers and they get the right quantity of funding at the right time and they do not do any distressed selling. Then there are pure agtech companies like, the Stellabs of the world, Dihat, Unnati, etc. Because while financing is not the main aim of these institutions, but they have critical data points of the farmers, which enables banks to piggy ride on their platforms and to be able to deliver financial services. And third is the new generation of impact funds, NBFCs like Samunati, Avanti, NatKisan today, which have taken huge kind of bets in the Indian agriculture sector. And some of them, like for example, Samunati, because it works exclusively in the agriculture sector, it's innovating into technology, it's innovating into climate smart agriculture, and it's doing all the difficult kind of financing which mainstream banks are yet to take up in the Indian market. Now, we have seen a huge revolution in the urban markets, thanks to the JAM Trinity, thanks to the development of NPCI, that's the National Payment Corporation of India, which was an initiative of RBI and IBA, which enabled a very robust physical and electronic payment and settlement system. Now we know consumer financing in the urban area has become so seamless and so easy that at times we do not even realize how credit is being provided to us. It's still early days in the agriculture sector, but I do hope that with the new initiatives being taken by the government of India, especially through the Act Stack, which is getting developed now, which is under debate right now, if that comes up in a meaningful way, because digitization of farmers is a very, very expensive affair. And the jury's out whether private capital needs to pay for that or government needs to pay for the digitization of farmers. But it is going to happen. And from the data I have, about 10 to 15 million farmers have already got digitized and they are already working on one or more electronic platforms or technology platforms. So that's the big hope for Indian agriculture and for global agriculture, especially in the countries which are dominated by smallholder farmers. Technology is the way forward because it addresses information asymmetry, it gives real-time data, and it makes credit decisions much easier for financial institutions, and they find it easier to piggy ride and to unlock capital once they have this kind of data. The new challenge for Indian agriculture today, and Dr. Bhanwala stressed on that, is the climate challenge. We are seeing it globally. The new IPCC report just got released day before, which is really scary. And agriculture is one of the largest polluters in the world. 1/3 of the global pollution is because of agriculture. And agriculture is a necessary sector because it needs to feed, it needs to provide nutrition, to 10 billion people by 2050. Thus, we cannot ignore agriculture, but whatever we need to do needs to be climate friendly. It needs to be environment friendly. In India, the inclusive journey had started many decades back, but the environment financing, climate smart financing is still very, very nascent. And I'll stick my neck out and say that without technology, to be able to reach out to 140 million farmers and different levels of aggregation, without technology, it is just not possible. For us to be able to address the the climate challenge, technology will be a necessary condition. So that's the future for India. It's the physical aggregation through FPOs and the virtual aggregation using technology. And the new age generation players which are coming into play, and they have started unlocking large capital from the mainstream financing institution. But what are the challenges? There are still some challenges which are yet to be resolved. The first one is whenever we see large mainstream banks working with fintech companies, one is that of system integration. It remains a big challenge. It's early days yet, but most of the banks are not willing to open up their core banking system to the fintech platforms. Second is the KYC challenge for mainstream banks as to how does the fintech companies' origination monitoring satisfy the requirements of the regulator. And the third is the credit scoring model, which is being developed by the fintech and the tech companies, is to how credible are these credit scoring models? What is the kind of algorithm they are using? Will it be used just as an input by the retail financing bank, or can they rely exclusively on that? It's early days yet, but it's very, very encouraging to see a large number of banks, including the giants like SBI, taking bets of working with large tech and fintech companies. The challenges which cannot be addressed by the technology platforms or the technology players per se are one of data sharing, data protection. These are still not resolved. We don't have norms, we don't have regulations or standards for that. And the issue of data integrity, extremely important. It's still nascent days in India, and a lot of work needs to be done to be able to enable rural financing, agriculture financing, leveraging technology. And last and not the least is the issue of data divide. Will it be that just the large farmers or the farmers in the semi-urban areas will benefit from the large dose of technology which enables access to markets, access to finance, and access to all kind of businesses? Will technology democratize itself to be able to reach out to the really smallholder farmers in the back of beyond and make it more inclusive? The financing of the mainstream banks, unlocking of the mainstream banks, reaching out to the smallholder farmers in the back of beyond. That's again a question that cannot be addressed now. Time will tell as to how we can democratize financing. With that, Deepak, I think I won't utilize the entire time, but that's all.
I cannot let you go without asking you questions. That's you finished early, so we can have some questions. Because the body of work you have done for decades in this sector is exemplary, and that is where my first question would be, Arindom, that that we always say that agriculture is a risky area, especially for the bankers. Fortunately, I was going through data of at least 7 or 8 countries for past nearly a decade, and you'll be surprised to know that actually the typically non-performing assets, right, in agriculture is either as bad as the industry or service industry, or even better in some of the countries than the industry or service related loans. Do you see that there is maybe a wrong perception, because we all understand because of the weather, government policies, agriculture itself is risky for the farmer, and we just extrapolate saying that it is also risky for the financiers?
Well, Deepak, I'll put it this way: agriculture financing is risky business. When I talk of agriculture financing, I'm talking of farmer financing, because the entire production risk and the market risk, the price risk that the farmer bears, the other players in the supply chain, do not bear the risk. So once the produce is in the market and it moves to other players in the supply chain, the production risk is taken out of the equation. I would say agriculture financing is risky, that farmer financing is risky, but innovation and knowledge is key. So far, it was only knowledge, but now innovation and technology is going to be a major player. And you need commitment. You need commitment of financing institution. If you take, Deepak, the example of my bank, Rabobank, it's the world's largest bank in food and agribusiness. Now, we don't have a choice. We can only do business in food and agribusiness. So we have to innovate. We have to invest in knowledge. But if other kind of sectors, easy sectors were opened up to us, it would have been very, very tempting to move away from agriculture and to do financing in the other big sectors. So that's why I said that's the success. That's the reason for the success of Samunati in the Indian market, that they have made it very clear they will not finance out of agriculture. That's why they are pushing the envelope and getting into all kind of innovative financing. But Deepak, I will again say agriculture financing is risky. You require deep knowledge and you require a lot of innovation to be able to do it in a meaningful manner. I'll not compare it to the other sectors because whether other sectors are doing well or not, it is irrelevant because we need to build up a healthy portfolio of agriculture for our sustenance and for the sustenance of the world.
Great. Second question is around, you have talked very specifically about data. And we all know that actually, today data is very critical in every sector, right? That's why we talk about Industry 4.0 and all those things, where we have started understanding that, data gives insight, which is very valuable for making decisions. Now, in agriculture, as you rightly said, that, who should be paying for that data, right? Are you seeing any green shoots? Because we have been talking about agri-stack and from the private sector also, a company like Cropin doing great work in digitizing a couple of million farmers, a million farmer there. But for country like India, Indonesia, which are having tens of millions of farmers, right? I'm saying that's scratching the surface. How seriously you believe that actually the governments and the private sector is interested in spending money to digitize farmers' data?
Well, so far, if you look at the technology companies, whether it's the large ones like DeHart or AgroStar or Cropin, that's been backed exclusively by private capital, right? But having said that, I don't think private capital will have the appetite to digitize 140 million farmers. So to me, the government needs to play a very key role because it's not only digitization, but it's about data security, data protection, data sharing norms. Now, all this needs to be put in place by the policymakers and by the regulators because individual companies will not be able to decide on, managing this larger kind of regulatory pieces which needs to be in place. So the government, I think, has a very large role to play. And in my personal opinion, the basic digitization, the static data, the farmer land, the farm data and the farmer data, I would say would be the primary responsibility of the government and not of the private sector. The private sector needs to build on that and to be able to get all kind of market players in the farmer ecosystem in a meaningful way.
Extrapolating on that, do you also see that if private players collect too much of data, that could be also detrimental to that overall national food security?
Well, Deepak, it's too early to comment on that because at the end of the day, once we reach a certain threshold level, say in a country like India or you took the example of Indonesia, there would be conflicts if we don't put norms for data protection, data sharing. So too much of dominance by one private sector could be of concern, but if there are multiple private players playing on a stack, which is, we'll have to define as to where the ownership of the data lies, but how the data needs to be shared, how the data needs to be protected are very, very key steps for, orderly growth of the database financing in the rural and agriculture sector.
Now coming to the the last part of my questions, this is more of about typically the blockchain or distributed ledger technology. how do you see that impacting agriculture as a whole? Because one thing is that reduction in cost of transaction itself. Second,
Absolutely.
I've been interacting a lot of players who to help them in setting up their own blockchain based solutions, and they are too scared with transparency. Do you see that acting as a negative leverage when it comes to blockchain deployment in agriculture sector in India or in developing countries?
Well, I'll put it this way: blockchain will take its own time. You will look at the evolution of blockchain. Right now, if you look at trade finance, even in the soft commodity space, in the agriculture space, globally, blockchain is playing a very, very important role because it brings in a lot of integrity into those transactions, and it cuts down on transaction costs. But it's the integrity of the transactions which are not questioned, which makes it a blockchain a very, very powerful tool. In India, in the agri financing space, it's on the post-harvest financing space that we are seeing blockchain solutions being deployed. These are small pilots yet, but I would say they are looking good. Now, whether blockchain can expand to all facets of agriculture financing, it's too early to jump to any conclusion. So let's wait for blockchain to scale up in trade finance globally for soft commodities, and in India in the post-harvest space to evolve. And then we will see as to what the potential of blockchain is. But again, technology at the end of the day is an enabler. So it's an enabler. It is not going to solve the real problem. So technology needs to, to ride on other kind of innovations, and blockchain is just one innovation out there.
Super awesome. Thanks, Arindom, for a really insightful session and answering all the difficult questions. And I learned a lot. It's with all the engagement with you. Every time I go home with more knowledge. So thanks
Thank
for
you
that.
so much.
And I'm pretty sure
Thank
our
you.
audience would have loved this interaction. We move to
Thanks,
our
all
next.
the best.
Yeah, thank you. So we move to our next speaker, and we are having Mr. Vivek Belgavi. Vivek is the partner and Indian fintech leader at PwC India. He's a financial service technology leader, identifying new market propositions, team enablement, key client relationship management. He is leading alliances and ecosystem across technology practice focused on MSME, Agri, health, and others. He's part of PwC's Global FinTech Council. He's recognized as thought leader and has published and presented papers on emergence of fintech and its disruption to financial service industry. Floor is yours, Vivek. Vivek, you're on a mute in case. Yeah, sure. Okay.
Yeah. Thanks, Deepak. Thanks for having me here. Just following the fag end of Arindom's chat, and was very informative, was very real. Looking forward to having this conversation.
Great. So you would be presenting or you'll be speaking?
So why don't I got a couple of slides just to talk through it.
That would be awesome. That would be
awesome. Let me know if you guys can see my text.
We can see it. We can see it.
Super. Let me see, how do I move it? Yeah, that's fine. So why don't so probably I'll take I'm not sure how much time, Deepak, we have. I can take around anyway.
You can go for 20-25 minutes. No, not an issue.
Sure. So probably what I'd like to chat through is a couple of areas which are pretty close to the work we do here at PwC. One is see how not just technology, but the kind of emerging models, that's the key part which gets missed in a technology debate. What we call as the ecosystem models, which is a distinctly different way to operate businesses. How does that kind of help in penetrating or expanding or solving problems into certain spaces? So I'll talk a bit more about it as I talk through the presentation today. The second piece is and probably linked to the first one. There is a lot of debate on what government will do, what private will do, but sometimes it becomes like a two-party debate. But as opposed to that, how can it be a multi-party collaboration? And what are the reference points that we have in front of us? We know that the problem is far from being solved. but how can we move towards some parts of at least solving the problem? So I'll probably kickstart by talking through some of the traditional issues. I picked this note from the RBI paper and many of the issues folks on the session today, from whichever lens you're tracking this space, would be very familiar with, whether it is declining operational holding, declining farm income, what we call all as dominance of dry land agriculture, degradation of soil. There is a fair bit of regional disparity. The capital investment is low. Market imperfections, which again has been a lot of focus for multiple governments and policy agencies, as well as which has become very pertinent right now around the threat of climate change. Like, all these issues are known. But I just wanted to, being a bit of an optimistic person, I was going to talk through some of what I call as the green shoots. I don't think the transformation will come overnight. I do think we're already on the journey. The situation today, is it better than what it was a decade back? Then the answer in large parts is yes. So what are the green shoots that I look forward to, right? So one is, and it's slightly broader, and this probably cuts across regimes as well. The changing shape of the policy, which is getting the subsidy or the support more targeted, more towards the end consumer or the beneficiary of the target. And this has been a subtle but a consistent change. A lot of that is moving away from input providers to the farmer. And I said it is slightly more broader than agriculture also, because from our vantage point, we are tracking this trend in some couple of other areas like education, energy, to name two more, which does mean like even a little bit of subsidy or a little bit of support when the money direction changes, it does change the way our ecosystem will now move towards the target, right? So which is a positive news if I was a farmer in the country today. Second, from a government intervention as well as private, there has been a trend towards creation of marketplaces, kind of addressing some of the challenges around market imperfection or the price spread, which was there on the left side, which is again positive. Linked to it, which we saw over COVID, and many of you would have felt it, it has accelerated a need for digitization across supply chains, and definitely Agri has been one of the sectors which has kind of adopted it a lot more faster and a lot more, because it was almost needed, both on the consumer side as well as on the producer side. It has really accelerated those models, though the effect is palpable only in some key cities, which we understand. But it's again an important development, because what we have seen in India is once anyone sees a model working, we are pretty good in replication of that model. So and this is a case which we saw across multiple platforms, very lightweight, which can just help in logistics, get the farm produce from anywhere between 100, 200, 300 kilometers around a city, back in a city in a day or two, and have it delivered to your doorstep by some local provider. That chain has really matured over last 12 to 18 months. The next piece which I could hear Arindom mention earlier was, and if I take a cue from where I have spent a lot of time, which is in the core fintech space, then what's called as a public-private infra for digitization. A lot of fintech was possible because of India Stack, and it is, while we call it as an India Stack as a coherent entity, it has got a lot of moving parts which were executed and continue to be executed by different authorities in tandem. So whether it is a Aadhaar required authentication, where we have a central UID agency, whether it is running payment switches, where NPCI and going forward NUE entities would be doing that. So the learning from there is it requires coordination across multiple agencies, and it may not be a problem or a solution which can only one department or one provider, whether it's public or private, can create. But having more, let's say, tangible conversation on operationalization of what now called the Agri stack will go a long way, and probably taking a cue from the larger government investment thesis. The roads and highways were the infrastructures of the 90s. However, talking about such data-driven infrastructures is the way the future digital infrastructure would get built. lastly, I think all these factors lead to a better access to finance, which was the main topic I was hoping to cover today. Now, to understand access to finance, we should understand the value chain, which a couple of components Arindom also referred in his chat. But when we look at this value chain, we have to understand that there's one way of categorizing it. There could be different ways, but we really wanted to bring it out to say it is not just a farmer or a consumer. There are a lot of other interested parties. And when people talk about digitization, where I'm hopeful is a lot of that can come from any of these parties. If tomorrow the equipment dealers start getting digitized, they will have a ripple effect on other parts of the value chain and will force other people to get kind of digitized or get onto the digital journey. Now that's an important statement because it does humble the policy initiatives, because we somehow think that we want a big bang solution. But solution could come from any one of these because all of them are correlated or interconnected. And if one party starts digitizing, then other parties end up following. So probably the chain that we highlighted today were on the one whole set on the manufacturing side, on the input providers, whether seeds, fertilizers, OEMs, whether there are dealer rental agencies, equipment rental agencies, or producers, which are individual farmers, groups around it, or something on the distribution value chain, whether they're warehouse aggregators, cooperatives, so on and so forth. And each of these has a role to play. Now, just to put some examples, we picked a few examples across the value chain. Each of these buckets today will have a fair bit of traditional setups. But what we are also seeing is the rise of, and these guys are not technology companies, they are digitized companies. They are hardcore. All of them can't work in this sector without heavy touch, if you may, or heavy on-ground network. But they have adopted technology to start giving more value to whichever segment they are providing. The other key thing is each one of them is now thinking that final customer is going to be a farmer or whichever my client is, a manufacturer or rental agency I'm working with. How can I give a 360-degree ecosystem services to that person? And everyone has their own ecosystem, right? So those are the two key trends to look at. And sometimes the solutions get created by combination. If I bring to life through an example, we were called in by one of the leading Navratna companies, which was asked by the government around the time of COVID to quickly extend the kind of a cold storage solution value chain, which this entity had. But the entity's cold storage solution really extended only at a wholesale warehouse or a mandi level. It didn't extend to the last mile farmer. And they didn't know how to quickly extend to the last mile farmer. So we spoke to one of the producer side organization. The name is out here called Unnati, which was servicing around 2 lakh farmers. They had built a tech platform. They were really solving for access to information to the farmers and solving for logistics from farm to the mandi, so to speak. But they had an open tech platform. So we could suddenly pull them together. We could pull someone like a Jai Kisan or a similar fintech together and come with a coherent solution to this large conglomerate, which was trying to create a solution for cold storage, to say, well, here is a partner who has got 2 lakh farmers. They've got a tech platform. So you don't have to start from scratch. So suddenly you can cobble together what you need by pulling together 2, 3, 4 parts of the ecosystem. Now, this is what I mean by an ecosystem business model. It suddenly says that it's not a marketplace. It is not saying that, okay, you can access anything from anywhere. It is to seamlessly and on a real time stitch together capabilities that you would need to create the end solution. Now, for this, the entire value chain need not be digitized. If the one person on the producer side, one person on the warehouse side, one on the dealer side, one on the industry side is also digitized, and I think we have one each for sure, then suddenly you can start creating some new solutions to the segment that you can go to. Now, how does all of this tie to the core part of it, which is financing? And here's where I want to take some real life examples. So whether your categories on the warehousing side, so we picked up a category like Allfresh, where Bank of Baroda has tied up with them to extend, because Allfresh is doing warehousing. So they have got a pretty detailed pledge of receipts, which the farmers do against their produce. So, and that has got history, that has got data. So till Allfresh is ready to digitize that and give that access to a bank can do that loan. Now, here's again, I'll make a small point which somehow gets lost in the whole data privacy debate. which is each of these players need not store this data, need not have access to all the data. If they have data at the right time to make that decision, and they have a relationship with someone like a Allfresh or a Jai Kisan or Star Agri, whoever is managing the customer relationship or has a sense of community, that itself can be a new world collateral. So that's how these new models are progressing. Same thing on the channel side, we have picked an example of Jai Kisan with Karnataka Vikas Gramin Bank, or in the agri financing space where something like a Star Agri or an Arya, or in the equipment financing space where with EM3. Now, each one has their own nuance, but it also shows what my initial comment was on green shoots of what is possible. When we look at these partnerships, we have tried to put through and kind of talk through a framework as to how do these partnerships happen between a lender, which could be a bank, and I don't want to see bank only as lenders also. They can give accounts, they can help in subsidies, payments, they can do they can give payment solutions. So bank can offer a fair bit of services to an agriculture sector. Now, what we are trying to capture here is if a lender or a financial industry has to engage with these players, which I captured earlier, like these players who are digitizing and are part of the digital. I'm the new digitized dealer. I'm a new digitized manufacturer. I'm a new digitized aggregator, or I'm a new digitized producer. Any of those categories, and these are the themes which it can take. On left side, it can be plain distribution partnership. So the example which I gave of someone like an Unnati, they have an access to 2 lakh farmers. They can say that, okay, well, Mr. Bank, this is the profile of the farmer. This is the information that we have. If you want to give a credit to it, then here are the terms. Are you fine with it, right? So that when you are acting at distribution, the better part of it is co-product, where you realize that again in agri, the income cycles are so much linked to produce cycles that we can't even paint the whole segment in one brush stroke. For me to finance a sugarcane versus for me to finance a grapes could be a very different proposition that I have to play with. So now I can co-design products where I have to go closer to it. So now once the data is there, as well as some kind of a customer engagement is there, most of the lenders are happy to come on the table to talk through this. On the other side are the digital capability partnerships. This is where it is less of financing, but saying if, and this we are seeing from banks as well, as they are trying to create their ecosystem banking platforms. They are saying if you have a solution which would be relevant to any of the agri ecosystem, let's say you could have a great warehouse management solution. Now that kind of a solution suddenly can also partner with a bank or with a agri-tech to expand the services. Or you can provide some specific value-added services, such as many farmers would want to create, let's say, some kind of a small white labeled online property to just list out what their products are. Right now, to do that, can someone offer them almost a website as a service, which they can tweak easily, and suddenly they are on, right, with integration, like those kind of. Or tomorrow they want to market that, to help them do some small digital marketing, whether it's a Facebook or Instagram or whichever channels they would want to prefer, or even a radio, right? So we have to become very democratized with regard to the channels, pick up both new age, but don't try to bucket it in our own traditional way of thinking, right? So there could be a lot more farmers today engaged on something like a TikTok than we might be aware of. If TikTok is not there on a YouTube, then we are aware of, right? So whichever channels are of access to them, or whichever channels are emerging, we can start offering a lot more services to them. But the key takeaway from this is the heart of ecosystem business model is that whichever segment that you're servicing and whichever product you're servicing with, keep that in your back pocket. Understand what that your ecosystem needs. If you're a dealer, what does the person need across him? If I'm a farmer, what do I need across him? And you don't have to deliver all those services, but through technology, you can create a platform by which other people who have those services can deliver it via you, right? So suddenly we have more folks coming together on a real time, and that's where I do think the foundations of change will lie. Another framework that we want to put on, some of the examples we gave earlier that we want to talk through it is from a partnership opportunity perspective, all the digitized agri players, if we put them into this matrix, is their business model D2C? Are they directly kind of working with farmers or the end producers? Or is their business model more technology, right? So that is one lens. The second lens is to say, do they already understand financial services, or do they not understand financial services at all? Now, based on these, you will have three types of partnership models which will emerge. If it is one, the first, which is the top right. Now, these are the players who are direct access to consumers, and they also have a good integration with financial services. Either they are financial services themselves, like Jai Kisan here, or they are like an Allfresh or an EMB, which has already worked with financial services. Now, here you can do both a distribution partnership as well as a co-lending partnership. The second situation is where my model is D2C, but really I have not traditionally focused on financial services, right? So here I can look at embedded finance, I can create co-product creation, like those are the opportunities which kind of open up. And the third category is the category which are more tech kind of businesses. So here the story which can happen is these folks can get involved in digitization of value chains and hence generate a fair bit of formal data, which through consent can be worked by lenders on providing the financing services to the financing or associated financial services to the end ecosystem. So that's a kind of a brief overview. Deepak, happy to go deeper or pick up any questions on any of the aspects.
Yeah, sure. So you have been engaging globally on when it comes to fintech, right? So again, I asked the same question to Arindom because, like, the blockchain is the flavor of the town, right? How do you see, like, that I'll say that spreading out in India? Or do you see there are, because of the data integrity, challenges of collection of data in agriculture sector predominantly, do you see that is going to pose some challenge in really ramp up of blockchain-based solutions in India?
I would think there are probably three paths, right? So the issue with answering this blockchain forward is it's almost like I have a hammer and now I have to look for a nail, right? So which is never a great ploy, so to speak. But really working backwards to see what are the issues and what are the ways the ecosystem is solving the issues, right? So for example, people say that blockchain might be very helpful for executing traceability, right? Which is a fair argument. But when you say that how are participants today solving that issue and who is trying to solve that issue, then you would realize that it would probably be supply chain organizations. It would probably be large input providers who want to track things through the value. They're only those guys. Then the question is, what do they use to solve that problem? So today they go and work with enterprise software companies to solve that problem. In which case, if blockchain has to get adopted, then enterprise software companies have to start giving them those solutions, which is happening as we speak, right? That's how that change will come through. Or if I pick up the second leg, and this was a real life case, there was an entity which came to us, they were running a pharma marketplace. And they wanted to see if they can embed crypto in that whole value chain, right? And kind of go for an ICO, if you may. Now, there's some value in that because, it is an ICO compliant business, if you may, because ICOs work where utilities are like, now in this case, imagine produce. So you can start giving tokens to each produce and start making a small ecosystem around it. And that token becomes an ICO. Then suddenly you can track all your transactions happening there and it increases transparency. There's a good use case for it. Now, if something like that picks up, then again, without you asking for it, blockchain will enter into the conversation. Or if I pick up the third thread, which is very real and palpable, which is India going deep into something like a CBDC, which is a central bank digital currency. Now, as India launches CBDC, now a couple of very apparent use cases. One is the whole subsidy angle, because suddenly you have smart money. You can give us 100 rupees for farming and you can code it to say, well, this will be used for farming and not for drinking, as a case in point, right? So now those are great use cases. Now, as that gets adopted, automatically other things will start coming through, right? So like this was a case point, we keep on saying that sometimes ecosystems get developed on a stack theory, right? For a Google Maps to exist, GPS had to exist. And for a Uber to exist, a Google Maps had to exist, right? So that's the way the stack theory gets created. But part is every aspect of the stack has to create very strong stickiness. You can't push. Now, any aspect, now CBDC creates stickiness, then your ecosystem will start developing on top of it. If the ICO creates stickiness, ecosystem will start developing on it. So in my view, it's not a blockchain forward conversation. It is really any of those trends kind of firing off, which will solve it. Now, if blockchain solves it, well and good. If it doesn't solve it, too bad, right? So be it, so to speak.
No, I fully agree with you. CBDC is the right way to move forward because, like, I strongly believe that for a country which is so predominantly dependent on subsidies in agriculture, right, you need to find a better way of ensuring that subsidies are utilized in the right manner, and then it's overall increasing the productivity. Hence, you have this vicious positive cycle. At the same time, I'm not a big, yeah.
Yeah, second, just on before that reminded me, second use case we have been brainstorming around CBDC was that if you look at the digital payment story today, while UPI and PPI and banking correspondent model, a lot of those have really helped in extending it to the last mile, right, to some degree. But real challenges do remain, whether it is urban setup or a rural setup, which is everyone doesn't have good network all the time, either because of logistical issues or because of financial issues, right? So, and now without that, we don't have a clear, or like you can't completely rely on UPI, right? So because that will require you to have connection. So now the thing with the digital currency is technology is making it possible, and that's a true distinction. All digital payments today are account based. You have an account and everything else is like a front end to that account. So you always have to check with that account, can I do this, so to speak. Whereas a CBDC is a completely an alternative thesis. It is a true alternative to a 10 rupee note in your pocket, right? So which also opens up completely new ecosystem, because suddenly you can drop, let's say 100 coins into a village. And a lot of those villages can be used for internal this thing without wanting a UPI all the time, so to speak. So some of those things are possible. Few more things have to be done for that to be plausible. But it can really create offline ecosystems which have been truly offline till now, whether they're in tolls and transit, they're in education, rural setups, you can take it. That's where probably even digital payments for us will move from a 1.5–2 billion a month run rate to something like a $10 billion, 10 billion transactions run rate, right? So that's a huge dark side of the ocean that we can completely uncover.
No, yes, 100%. So, like, all I believe that needs to be done earlier the better, right? And see, leapfrogging of developing countries can only be possible if they take a little bit of risk, right? I can remember in 2000 when I was talking to, like, very senior management of ICICI about OTP being used, right, for mobile financing, mobile transaction, and it was clear no. Right. And now today, like, Deepak Parikh's name doesn't matter, or my physical presence doesn't matter. Actually, it is my mobile number with an OTP. Then only bank will accept that I am Deepak Parikh. So the world has to be, like, I'll say that be more considerate about innovation, because even small innovations can play a very vital role. And coming to your traceability story, I also am not a big fan of traceability through blockchain, if you ask me, right? They are far, I'll say that, overrated story, right? And we did in 2018 a small project for a very big input company for using blockchain and traceability. And believe me, after all the parameters being, like, better than what they were expecting, they say it is too transparent, right? So those challenges always happen. And thanks a lot, Vivek. It was pleasure having you for this roundtable, and the value you added, the insight you put on the table was really awesome. Thanks a lot.
Thank you so much. It was a pleasure engaging with everyone. Thank you. Bye.
Sure. So now let's move to our next session, and which is a panel discussion where we are having speaker, one banker having worked extensively in banking sector, working with typically financing of agriculture and food sector. We are having, I'll say that, a veteran startup leader. And then we are having someone who has been monitoring and working on climate change very closely. So let us welcome Mr. Santosh Mishra. He is an agribusiness professional with more than 2 decades of professional expertise. He is currently the business head of priority sector financing portfolio and food and agribusiness strategic advisory and research at the Yes Bank, based out of Mumbai. He has been with Yes Bank from 2010 till date in various positions, handling agri portfolio across India. Previously, Santosh Mishra was a part of ICICI Bank as part of global risk management team. Santosh has also been an impact space professional and has worked with not-for-profit sector and handled large-scale development projects. Our next speaker for this panel is Mr. Mohammad Aatish Khan. Mohammad Aatish is a co-founder of NatureDots, building an award-winning hard-tech product, AquaNurture, combining natural science and deep tech with an ambitious dream to create a digital twin of all the freshwater and critical marine ecosystem in the world to understand complex natural resources at scale for establishing nature positive growth. He is building NatureDots with his 12 plus years of experience in accelerating high impact ideas to commercialization across 50 plus business projects in 20 countries, from grassroots to global corporation. He has led high performance interdisciplinary multi-geography teams, innovated solutions in natural resources, clean tech, and mobilized close to $200 million green finance. And the third speaker for the panel is Mr. Abhilash Thirupathy. Abhilash is the founder of Agrifi. Agrifi provides a sustainable income and livelihood to the farmer by providing access to a digital connectivity to the farm, that is credit and inputs, and from the farm, that is output marketplace, therefore alleviating the short-term risk and assisting in long-term sustainable planning. Thanks a lot, gentlemen, for participating in this panel discussion. It's honor to have all of you with the deep, I'll say that, extensive understanding and knowledge all of you have. I'll start with Santosh. Santosh, your extensive experience in agri finance. So my first question for you would be like, how do you see financing Indian agriculture? Is it an opportunity or a challenge?
Yeah, that's a good question. I think elephant in the room kind of a question. Yes, both. I would say both. Going forward, it will be more of an opportunity than a challenge. It used to be a challenge, no doubt. In my view, when we talk about financing agriculture, common understanding becomes agriculture only farmer, or maybe a first level of aggregators. But we, as a banker, we believe that when we talk about the financing agriculture, the entire value chain again may not go up to the large corporates or large food processing industry, but at least up to the SME level, where we see both challenges and opportunity both, correct? That is one part, from farmers till, let's say, small processors, farmer, adatiyas, then middleman, then up to that level. Second comes the overall top support system. Seed companies are there, logistic providers are there. They're a very important part of that one. And third, and also I would say very, very important, is the storage. Okay, so a seed, input sector, logistic, and storage. So financing farmer, and with these two addition of the value chain till small scale players, I would say this is the sector we are talking about, which poses both challenges and opportunity. I feel that going forward, it will be more of an opportunity. The few pointers for that one, yes, if you traditionally looks what banks have been doing, they have been also been doing for the first level of value chain, from farmers till small processor. Same, we have a typical product like Kisan credit cards, we do tractor financing, we do some small OD loans, we do some small gold loans also, different kind of loans to farmer. Then we move to a small aggregators, we do some OD product, normal working capital. We move towards SME segments, then starts term loan for the capacity expansion, for the new projects and all, everything. And for a traditional, let's say, for a seed company, again becomes we give working capital and all. Seed organizers, we have similar kind of a product which we give to a normal farmer. Whatever loan do we give to a farmer, a variation of that, I would say, a small variation of that loan goes towards the input suppliers or input farmers. For a small logistic company, every bank has a typical financing product like vehicle loans or fleet owners loan kind of a thing that is there. Definitely it was a challenge of a manifold. We all understand those challenges: small, inaccessible, lack of data. Banks have their own issues of understanding the credit, how to do underwriting of the credit, and also most part how to mitigate the risk of that part. So we have moved a stage up above, I would say, ahead in terms of technology and the kind of data currently we have now, and various kind of digital payment solution being available. At least part of that risk is being mitigated in terms of we are able to gauge that risk in that area partly, and partly we are able to mitigate that risk in terms of some kind of cash flow is available, a visible cash flow is available, which we can track it. So I feel it was a challenge. Going forward, it will be an opportunity.
Great, very well articulated. Now, my next question is around the same thing which you just raised. Like, do you think that like the startup ecosystem, which is pushing a lot of digital technology, like, previously it was very difficult for bank to understand what farmer is growing, except when he said that I'm growing bajra, right? Now you are having companies like Setsure, a company like Cropin, which are making available that level of granularity in the data which a bank can have access to, and then process that. Then there is companies like Credit AI, which is also working on the models to how to use the transactional data of the farmer, which is very difficult again because of access to those organized banking channel by farmer is not there. And trying to work on those models of doing a bit credit rating based on the various data points. Do you see that this digital technology is gonna make this opportunity far more scalable than what was in past?
Yes, see, there is no doubt that this kind of initiative or this kind of development which has happened in the past is going to redefine actually the way the banks are looking at underwriting the small producer, all the small producer. No doubt about that. There are two parts of it. One is that this startup ecosystem has actually, what should we say? We have actually, they have really woken up these banks. You have to look further. Wake up now. Wake up now. So this is the time you have to wake up. Whatever you have been doing was, we have been doing in our own shell. We thought that we know financing part well, but there is much more to financing per se. Unless we understand the overall business, overall dynamics, overall ecosystem, overall behavior of that borrower, it is very, very difficult to scale up anything. So we're talking about those companies which are technology-based weather companies, which might provide the data to the banks on a real-time basis that whatever crop you have financed, as per whatever farmers had told, this is my land, this is what I am growing, correct? This was the two times crop in a year I take, or 3 times crop in a year I take, or my land is irrigated or not irrigated. Basis that you have some scale of finance and you have done some kind of financing to that. But what is happening after that? Do the bank have that kind of reach or understanding, or sometime I would say willingness to go up to that field level and check regularly what is happening? The way we do go and see the factories of a borrower who are large corporates. Whenever I give a loan to a big corporate or anybody, we visit. We take chartered engineers, chartered accountants, specialists with us, go to the company and see what is happening in the company. Where is your raw material? Where are factory? Where is the connection? Where is everything happening? Where is your stock statement? How much money have you taken? Are we ready for that one to go up to that level of underwriting the farmer and do that? No, we don't. So what do? We just gave loan, wait for that loan. We also know that loan is there. After 1 year, farmer will pay the entire loan to you and again take it back. But what happens is something happens in between. Now, weather is changing, you also know very well, we have been seeing. Now, we don't know which area is going to be impacted, how fast, how soon, and when. Maybe out of the blue, somewhere you see there is a landslide, there is a rainy season, whole crop is gone, and bank is sitting on the huge debt. Sorry, bank continuing on the huge loan and all. So this kind of company, like weather companies, definitely there is one step. The company which are into various kind of digital solution of banks has a huge issue of know your customer, let's say. Now there are many things available where you can actually do it online from a remote, though I'll say fully not yet done by the bank, not yet done. It is still mostly on the paper, but yes, some of the banks have started doing this. We have also started doing this, but not at that scale which we should be doing that, to be frank. Remotely, we can do that. We can onboard the customer. We can disburse the loan. And there are various companies which can give you data, real-time data, that what is happening in the field. So definitely, no doubt, this is going to help us. Only one problem what we see as of now, we have not been able to fully rely on is the credit scoring model being developed by the many, startup, where I would say what the issue, there are many companies, you also know, many startups who say that yes, basis on the various data available and basis of their own experience, let's say machine learning, AI, correct, various kind of other data pulling from the various kind of credit scoring model, we can do that. But still, I feel there is a lot of hesitance in the banking system and in banking professional to take those at a face value. They still feel that, yes, I need a file. I need to check our credit processing agency or partner will check that file, do some tick marking, have our own intelligence going into them, then we will decide. So there is a kind of a departure which needs to go up to that level. Only that area, credit scoring model. Rest, I think other part banks are definitely there and they are willing to partner companies in those areas.
No, I fully agree with you. Sometimes few things bank has to pretend with themselves. Otherwise, actually, they are getting into a position where they are killing their own competitors.
They think that. That is happening, yeah.
I fully agree. So I go to Aatish, connecting to what just Santosh said. Aatish, digital twins is a beautiful theory. right? And where you are able to see what's happening, right, in the physical world with the lens of digitization. We would like to understand a little bit more based on your experience of handling a lot of projects across the globe where you worked on digitization of ecosystems. How do you see Indian agriculture getting digitized, and where do you see the value of that coming out in agriculture finance particularly?
Thank you. First thing, good afternoon, everyone, and thank you for all the attendees as they are silently listening what all we are sharing to be part of this discussion. One thing out of my experience, which I have noticed almost across all geographies, is the whole finance in this sector, not only with the agri sector. Just a second. Not only with the agri sector, but also with the allied sectors. It's about knowing or information about risk and how much the risk we can control. And the whole finance revolves around it. The second part is about the transaction cost, which now with the digitization, we are kind of addressing both issues. We are able to understand whether the kind of risks, not only in agriculture, in aquaculture, even in high value crops, because agriculture has a multifaceted products in it. Not only the crops, it has fruits, it has flowers in it, and it's very diverse. It's kind of coming as a whole sector in its true sense these days, I would say, which is appreciated by banks, which is appreciated by startups. As a startup, as an entity which is working to bring technology to solve these issues, we are continuously working with the farmers to enable them so that they would able to understand the risks, and the finance will, what they control would give us a better return. And that's where I think the role or balance of risk handling, because at one part, obviously any institution who is mobilizing finance, providing help to any kind of business will obviously save the flow of finance through understanding, controlling risk, understanding the features of business, whereas the customer who is using it, whether that customer is really able to control that or not. Now, when in this whole value chain, if both things are balanced, I think the industry grows. And that's where the earlier, if you see the example of earlier days of automobile loans, which everyone, as Santosh was saying, people used to go and check where a person is living, what kind of earning is there. But now these days, it's just a matter of a click and you can have an access to automobile loan with some kind of a credit history and all. So I think that kind of a thing, we are progressing in this sector, especially with the help of technology, with the help of understanding of the all market segments. The whole value chain is opening up in terms of information, in terms of flow, in terms of its integration with the new technologies. For example, if you see, even in agriculture, the hydroponics is now coming up. That's a well understood risk in that particular kind of a way practice a farm is happening. Similarly, the new technologies, the advanced methods which farmers are adopting these days, where one would have some sense of productivity, growth, understanding, integrated obviously with technology, with weather, with the kind of seeds they are using. So there are a lot of these agents which are continuously playing in this sector. And I think that is in next 5 to 10 years, I would as a startup definitely see an exponential change in this sector, not only in terms of the volume, but in terms of also the way agriculture has been happening in India. It's going to be transformed in next 5 to 10 years in a big way.
Great. Now, again, a follow-up question on exactly what you said. As you rightly mentioned that, we are having a diverse sector which needs, I'll say that, a lot of data, right? And as you rightly mentioned previously, the car loan was so difficult. Now it is more moving to the transactional data. And based on that, your credit scores are there, and then the financing happen. Do you see that those type of data would be able to be collected for, I'll say that, a difficult sector like agriculture or horticulture or even aqua? You're on mute.
I think, yeah, sorry. All these sectors will take its time, basically, as I said, because we don't really understand many parameters. These are not hardcore mechanical driven or tech driven solutions or products or services around. a very big part on nature has to be play in it. Now that's a very complex agent in terms of in this whole equation if we see, and that variable is very difficult to control. Even despite of all support, all science we know, overall play, how the nature is happening, its impact, or I would say the climate risks, which we don't really understand and we try to understand. And those variability has been having a lot of impact on aquaculture. For example, if you see, the growth of fishes are not only directly depend on the kind of a weather location it is, but also it depends on the kind of a, I would say, geographies, the kind of weather it is directly kind of integrating in it. So all those things are playing a very important role for defining this.
Perfect. So I'll go to Abhilash. Abhilash, you have been an old hat when it comes to agriculture technology, right? You have been some early starter in this sector. We would like to understand from you, like, you're already working in this sector, like, typically agriculture financing and using technology to solve the challenge of agriculture risk and financing around that, and with the ecosystem model. We would understand from you that where do you see the challenges in this sector, and where do you see actually the big bang opportunities?
Okay, first of all, thank you. A lot of respect for the people who are part of the panel. Some of you, or all of you, are very, very experienced. I'm mostly a field person, so I may not be able to come up with numbers, but I think the opportunity for financing in general and financing agri in specific are very, very large opportunities. I think the real opportunity lies in the fact that the products that is available for agri today, it's basically a distribution problem. I think anybody in the banking side will accept that. It's not that we don't have products or don't have money or the intention to lend. It's basically how do you reduce your cost of customer acquisition. The second is most of the credit underwriting models are focused on the MSME space or the working middle class. So specific underwriting models have to be developed, keeping in mind variables which are very complex. Like, for example, one thing was climate change, right? In spite of your best efforts, you put the best seeds, you put the best inputs, the farmer does everything on time. But if one rainfall is missed, everything goes for a toss. So how do you incorporate that? And then something which is come up more recently is the whole value chain approach. Unlike a salaried class, the farmer is very unique in that he makes only balloon repayments. So how do you ensure that the money that the farmer gets after selling his produce is not used to buy a two-wheeler and rather is used for settling the loan? So how do you align the incentives in within the platform so that we don't even have to follow up with the farmer? So I would essentially say that is where the real opportunity lies, in having a low-cost distribution system, specific underwriting algorithm which takes into account the complexities of agriculture as compared to any other asset class. And third is the value chain approach, where you have the incentives aligned with among all the ecosystem players to ensure that repayments happen automatically. Just like the salaried class, I don't have to go and make a payment in a bank for let's say a vehicle loan that I take. The e-NACH just works. Why is it not working in Agri? Even the vehicle loan was not like this 20 years ago. The system took some time to get here. The same thing has to happen in Agri as well, where as soon as the farmer sells his produce, it is securitized in an appropriate infrastructure-driven platform, and the banker who for whom the payment is due gets it without any follow-ups. So 3 pillars: low cost distribution, a unique underwriting credit underwriting mechanism for Agri, and third is the value chain approach. I think if there is any startup who can crack even one, if not all 3, I think we'll really be there in terms of agri finance. And any bank that I've met today, they've shown absolute willingness to participate. I think one of the biggest challenges is the fact that for a startup to get from that 0 to whatever scale that the bank deserves is probably the next opportunity for us to take serious consideration of, right? So I mean, I'm an entrepreneur, so I speak very short sentences. I come to the point because I'm always used to making presentations. So I'm not able to speak at length, but glad to take any follow-on questions.
No, 100%. There is a follow-on question, and short statements like, generally people who work directly facing the heat on the ground, right? They have this habit of closing their conversation fast. Nothing wrong in that. Actually, I had that avatar, I think just 12 months back. So that's fine. Yeah. I love that short conversation. So now next question to you is that, like, how difficult it is to convince a bank, right, to go for any new model. I'll just give one small example. I was promoting a company which has worked beautifully in creating a very good credit rating model, right, to a very big bank. And they said, Deepak, beautiful, awesome, great. Just ensure that actually you are able to give some guarantees to back your credit rating, right? I said, then if I could have given the guarantee, I'll open a bank, right? So how comfortable are banks in adopting the technology? Like, I'm saying that one thing is that appreciating the technology. The other thing is that, like, saying, okay, fine, I'll take that risk because you have created something awesome.
So I think it is definitely a catch-22 situation when it comes to, building a lending startup. Which means that when you go to a bank, one of the things that they are very particular about is that, the vintage, right? How much of a book size you have. And it's like a kind of a circular logic, because to build vintage, you need to raise capital. To raise capital, you need vintage. So it's kind of a chicken and egg situation. I think the best approach that most of the startups which have done some good work in this space have done is that they've done something which is like just short of capital, which is to build a good team. Right. So unlike any other startup where you don't necessarily need people with experience, I think if you are in the fintech space, then you need to build the team accordingly, where you have people with that experience, like the sales experience, the collection experience, the technology experience. Right. Once you get that, I think there is no dearth of capital today. Like when I started my previous startup in the agri space about 6 years back, it was forget raising capital. It was difficult to even get people to join the company because, Flipkart was the in thing. There were so many, more attractive, more flashier jobs. But of late, I would say the moment has come where Agri is in the spotlight. And there are so many people who write to, not just me, I think I would resonate with a lot of other entrepreneurs saying that I'm bored of doing whatever job I am. I want to do something impactful. And the first thing that they think is Agri, because 8 out of 10 people that you meet will have some connection with Agri. You just cannot debate. My uncle is still cultivating, or my grandfather is cultivating, or my father himself is a teacher in the school, but we have landed in our village. So I think that dearth of capital and the dearth of talent is still manageable. But the most important thing which is required, in my opinion, based on my experience as well as my conversation with other startups in the lending space, is unlike, let's say, selling a tractor or selling inputs, lending takes time. It is cyclical, right? So you have to go through cycles. So you have to be very, very patient, and you'll have to also build a team accordingly. If you do that, capital will come. If capital comes, you'll be able to build a vintage. And that's what banks want. And again, banks are of different sizes. Every bank doesn't want the same ticket size. One bank will say, I want 50 crore, but there'll be a small private bank, and RRB will say that, okay, 1 crore vintage is also fine. So I think you'll have to structure your strategy accordingly, or go to market saying that first I will build a team, then I'll get the capital, then I'll do 2 cycles, then I'll go to this RRB first, then I'll go to this private bank second, then I'll go to the big guys, right? So you go to the SBI or the Yes Bank, where you need to show a loan book size of, let's say, at least 10 crores, 25 crores. So it's a very structured approach that you'll have to follow. Does this answer your question?
100%. Yes, it does. Going back to Santoshji, we have been seeing in developing world a lot of talk about corporate farming, because if you see that agriculture has always been a priority sector in most of the developing countries, right, including India. But the loan books are not swelling the way the governments want. And suddenly you are seeing that a lot of corporates getting into agriculture. Would that make life easier for banks to fund corporate farming project rather than getting to the small and marginal farmers, and which is not that much lucrative, and which is having its own challenges, as you rightly mentioned, to go to a small 0.1 hectare farm or 1 acre farm, or go to like, 100-hectare farm and then like, get out with that compliance requirement of funding the priority sector?
See, there are two aspects to this. When we look for priority sector, then priority sector guidelines are very different for corporate. So if I give a loan to a corporate for financing in agriculture, there are certain limitations. More than that, I can't go. More than 2 crore is not allowed. There are many companies who are into agriculture. So different states have their different laws. Like Maharashtra may not allow the companies to own land. Various other states like Kerala, or you go to MP or to Odisha, they might allow companies to own land and all. So basis that, if you ask me, yes, in terms of overall banks view for the ease of doing business, what Mr. Abhilash was saying, to reduce the transaction costs. Yes, if there are some good corporates where we know the balance sheet, we have seen this guy has so much of net worth, we have this balance sheet which can be leveraged very well. Why not give loan for agriculture? That's quite easier to be done. So there is no doubt about that. In terms of, if you ask in ease of doing that. If we come to priority sector and regulatory and compliance aspect, yes, that is not that easy to do that, because that is a separately different aspect altogether. Earlier, I think 7-8 years back till 2013-14, then loan to corporates for different kind of activity used to be classified the way the current loan to small and marginal farmers are being classified. So please understand how the regulation have also changed. Earlier, when I used to give a loan, let's say 10 crore to a food processing company, out of that 3 crore loan, I can show as a direct agriculture financing, means which is akin to small and marginal farmer financing currently. So that era has gone. The regulator has also understand that it's very easier for bank to build that book. That time, if you see priority sector lending shortfall used to be very limited. All the banks used to meet their priority sector lending targets. Correct. Now what has happened? Regulation have changed. Post 2013, 17 is changed, 18 has changed. Now RBI has come out with a new regulation just 2 years back, separate target for small and marginal farmer as a category. So every bank has to meet 10% of the overall NBC for this agriculture finance, which is called small and marginal farmer. To answer your question, first part, yes, easier for people like me to look at the balance sheet. I know I can leverage it, give the loan, money will come back, fine. But when I look at the overall priority sector requirement, it will not fit the muster, I think. There are a lot of challenges would be there for a corporate. In terms of this area, how it is growing, yes, we have seen there are a lot of corporates who are into contract farming. We all know that there are Cargill, there are Pepsi, there are many people, McCain is there, where they have been doing this contract farming in countries since long. There was no law pertaining to that one. Enforceability was an issue. So there was a farm laws which are brought into 2-3 laws. Out of that, one law is also pertaining to the contract farming. But then we will not go into the details of that, how good, bad or ugly that is. But whatever it is, that there is something which can be done. So when we look at the corporate looking into agriculture or doing contract farming, that will definitely give 2 areas, which is one is the market linkages and offtake risk. That goes away. Correct. That goes away. You have been doing financing, value chain financing for the farmer on the back of corporate buying that produce. So your risk of offtake is going away. Only remains is the performance risk. You have given a farmer a loan, whether that farmer will be able to grow potato or not, up to that level. But that is also being monitored, mentored by that corporate so that it grows the potato and gives that potato for chips. So your risk to that part is very limited. Your performance risk compared to a normal farmer funding and to a farmer which is attached to a corporate is very limited. After that, you also know that corporate will buy that and give money back to you. So the offtake risk is gone in that one. Land leasing, entire scalability, that is taken care of that one. So that is no doubt would definitely, from a banker's point of view, it's fine. Yes, easier.
No, just moving on the same question, connecting the other dot. Now, the community farming being promoted, whether it is through FP or FPCs, do you see that also having the same impact as you rightly mentioned, that like, market linkages and other risks become very limited when you are lending to a farmer connected to a corporate? Would that also happen for the FPOs and FPC, or do you see that it is a little bit of different ballgame?
Yes, if you talk to me, if you ask my views on overall farmer collective doing this, so that is a corporate collective. So they both are collectives. One is in the shape of corporate, one is in the shape of farmers collective. Here, limited people with a single minded approach of profit as there, which is driving, and there are a lot of system, process, everything is there, correct? Here, there are a bunch of people who are from a same geography, but in terms of their constitution, they may be homogeneous, but very, very different kind of entity. So farmer producer company as a collective doing the community farming as an activity, it would be fine. In terms of scale, it will be okay. In terms of reducing my transaction cost, still fine. But in terms of mitigating risk, may not be that well done here as it is done in corporate. The reason being that unless there is a offtake, unless there is a quality produce, unless there is a mentoring, unless there is a monitoring, it is very difficult. And just to give you, you also know, currently there are 7,000, let's say, FPCs in country. I'm talking about only FPCs, not FPOs. Cooperative, I'm not talking about. It's a long list of cooperative who are good, bad, ugly. Good are also there, bad are also there. Look at FPC, which is a amalgamation of thoughts for cooperative and private sector, is the FPCs, farmer producer company. So there are 7,000 farmer producer company. Out of that, I would say more than 80% are just not more than 5 years old. Okay, and out of that, the FPGs which are not more than 5 years old, 46 to 50% are inactive. They are not active. The FPGs which are old, out of that, maybe 30-40% are there. And their average capital base of this FPO is hardly ₹1,00,000. Average base is hardly ₹1,00,000 because total capitalization of FPC in the country is 860 crore rupees. That much of capital is being contributed by the farmer members to form a cooperative FPCs across India. So average for 7,000 comes only ₹1,00,000 a capital base. So you understand the people coming together with a capital base of only ₹1,00,000 doing a community farming, and you thinking a large scale funding to mitigate a risk, slightly a different proposition. Yes.
I fully agree. Yeah. Now I'll go to Aatish. As you have heard, even Santosh talking about it, right? How do you see the challenge or capability of farmer to adopt some of these deep tech, right? Which is so costly. Like digital twin is not a cheap technology, right? So there is when we talk about AI and ML, the cost is prohibitive for small and marginal farmers. How do you see, developing world, wherever you have experience, right? The adoption happening.
Totally. I think that's a very important question and the basic question for all these startups who are working in the tech space in this sector. We at NatureDots, our product is Equinox, which we are developing through AI and bringing deep tech. We are one of those hard tech startup working with fish farmers all across India. Initially, that is also a very unknown for us when we started. But what we are offering fish farmer that your whole catch would be de-risked, use of certain technologies, understanding how the whole farm is behaving. Similarly, initially when different technologies and different agri space is coming, that understanding, because it's a natural system, and that's where I think the buying power started coming more. So it's always there. It is that a risk which is eating up. It is that the loss which is kind of continuously hitting farmers on that particular aspect. As soon as they started adopting, we also started kind of, I would say, bringing more low-cost technologies to address the same problem. Initially, that is a learning curve as a startup, as a tech, advanced tech. When you bring in, obviously, initial it's always cost high. But as soon as we started getting more leverage, we started understanding more data, the cost started getting reduced in this sector. And this has been happening initially when the whole IoT and whole AI ML, as Santosh said, came into agri space, the cost was very high. But now it's continuously going down because there have been now a lot of information available, which is very easily available to these startups and companies like us, where we can bring more valued information to our associated customers, or I would say fish farmers and agriculture farmers. And that's where the cost started reducing. There are few hard barriers in this overall segment. For example, when you're talking about hardwares, which are going to the obviously agri farms or aquaculture farms or even fruit farms, orchards and all, that obviously India is not manufacturing many of those. Many of those we have to import. Either we are importing from Europe or we are importing from China, and that always creates a barrier that, okay, till this point only the cost can be reduced. Whereas the rest all part, whether it's a SaaS, whether it's a DaaS or the services, which is a part of value chain, all those costs are now getting distributed. So the cost which earlier a farmer is used to bear for all the technology a farmer is using, that cost is now getting distributed either on a backward or forward in the value chain. And because the whole production is coming from the farm, all these startups are more strategically playing around in this space, so that the cost was a little bit distributed on this horizontally. And then the fish and agriculture of fish farmer won't really directly bearing all the costs. And that's where I think more buying and more scope of market evolving.
Perfect. Very well articulated. So Aatish, thanks for this very insightful answer, because I strongly believe that in agriculture, you cannot have farmer pays for all, right? We will have to distribute it across the ecosystem. And that again brings me to Abhilash. Abhilash, you have been a big fan of platform economy. So we would like to understand from you, right? How do you see that the cost of the technology adoption in agriculture sector, right, distributed across different ecosystem players?
I think the most important thing that differentiates a platform from any other business is the fact that we leverage the existing infra. I mean, we don't build something new. So if you look at gig economy, basically you're trying to get people who are already having two-wheelers so that you don't have to build that afresh, right? So I think it has to be a private-public partnership, because I mean, obviously a startup cannot build all of the technology, and we don't have access to the data that the government has. So I think a private-public partnership, which kind of gives a startup good access to the available infrastructure, will be a huge first step in helping mitigate risk. And I think we also need some very interesting low-cost insurance products, which can be distributed very, very well by startups, because one of the biggest challenges that any lender faces or any startup faces when going to a lender to ask for a partnership is what happens if there is a weather risk, what happens if there is a drought, right? And I don't think our energy, the energy of a startup is best used by selling these insurance products. There should be literally a program akin to, let's say, the PM. I mean, he transferred money, right? I think insurance is probably another important product that should be given about nationwide coverage, so that it helps limit the amount of risk or mitigate the amount of risk that a lender or a startup faces when we are trying to do this, because a bank is profitable because of a portfolio. A startup will take at least 5 years, 8 years to get to that kind of a size, where you have a diversified portfolio and your risk can be like distributed across several products, several geographies. Until then, you need some kind of a safety net, which helps us, go through this process. Because, for example, COVID happened, and suddenly now NBFCs are very, very wary of working with startups in the agri space, because the first wave of COVID did not hit the rural space, but the second wave really hit the rural space a lot, right? So I think instead of just looking at distributing costs, I think a customized nationwide free coverage kind of a insurance product coming from the government will be a huge flip to provide us the safety net before a startup reaches a particular scale, when they have a diversified portfolio and can sustain. I mean, if I'm across, let's say if I'm a startup, I'm present across 5 states, across, let's say, 20 crop lines, then one drought in one state or one bad event, one market crash in a particular commodity will not affect us that much, right? But until I get there, I think, some kind of a support system like a customized insurance product will be very, very helpful. But apart from that, I'm not able to think of any other cost sharing mechanism, so to speak.
I fully agree. I am still not able to understand why the majority of developing countries cannot go for parametric insurance, right? It's one of the simplest thing, right? And most, I'll say that easily, efficiently manageable, right, process. But again, I believe, we still believe in doing crop cutting experiments rather than actually just taking satellite-based data and say that no, typically the monsoon has failed, so pay the farmers. With that, we had this end of this panel discussion. It was very interesting, and I would like to summarize saying that distribution need to be sound, insurance need to be taken care of, and more corporatization of farming will definitely help everyone, and especially the bankers. Thanks a lot for your time, and it was a pleasure having all of you, sir.
Thank
Thank you
you.
very much.
Thank you.
Thank you, Santosh.
Pleasure.
Thank you,
Thank
Deepak.
you.
Thank you,
Thank you,
Aatish.
Mr. Aatish.
Thank you, Abhilash. Thank you, Santosh.
So now we move to our
Thank you, Deepak.
next. Yes, thank you. Now we move to our next speaker, Rajesh Malhotra. Mr. Rajesh is CEO at Maha Agriculture Public Company Limited, Myanmar. He's having experience of different industries such as F&B, NBFC, manufacturing, retail, advertising, agriculture, in over 25 years of professional career with various corporates. He has expertise in financial analysis, project management, new business development, financial policies and procedures, corporate finance, people management, legal international accounting, HSE investment, and corporate governance. He's heading one of the company which is a big name in Myanmar, has been doing a lot of interesting work in Myanmar. And Rajesh has been a good friend for years, and we keep on bumping each other at World Economic Forum events. And he once hosted me for a very nice lunch in Rangoon or Yangon. Thanks, Rajesh. Floor is yours.
Thank you, Deepak. Thank you for these good words. Let me share my screen before we continue. Where is my screen gone? Wow. Interesting. I cannot see my presentation myself. Something is surely wrong. Give me a second to.
Yeah, sure. Please take your time.
Hey, Neeraj, I'm unable to see my own presentation. How do I share? How do I share?
On the bottom, there would be a shared screen.
I know. I'm seeing all that, but I'm unable to see my presentation screen. Ah, there it is.
Okay. Perfect. We can see a presentation. Yeah.
You can?
Yes.
Give me 1 second. Is it okay now? Can you see?
Yeah, we can see, but we cannot see it on the full screen. We just see the slides.
Oh, I have done the full screen already. So give me another second, please. Now, is it okay?
Yes.
Okay. So Deepak, firstly, thank you very much. And HnyB, thank you very much for inviting me and giving me this opportunity to speak on a very, very interesting and challenging topic of agri-finance. It's a very, very vast subject, and I've been hearing last couple of minutes of the panel discussion with something fairly very interesting discussions coming up. But before we get on to all that, let me start off by some introduction. Deepak has given quite a bit already, but let me say myself, I'm Rajesh Malhotra, chartered accountant by education, and having more than 30 years of experience. Probably Deepak has the old resume of mine saying 25. I added probably 5 more onto that. I worked with 6 countries in Asia: India, China, Indonesia, Singapore, Vietnam, and Myanmar. In one of my earlier roles as a CFO of Asia Pacific, I was managing operations for 18 countries in the region. I've been involved, as Deepak said, in very many industries: hospitality, manufacturing, retail, advertising, agriculture, of course, financial services as well. The past 6 years, I'm based in Yangon, Myanmar, as a Chief Financial and Investment Officer for Oba Group. And as Deepak said, one of the very interesting group in Myanmar, having lots and lots of agricultural services business, including agrochemicals, fertilizers, seeds, ag tech, and agri financing. And I'm currently the CEO for Maha Agriculture Microfinance. Let me run through my presentation using Maha as a showcase here. Screen visible, Deepak? Everything okay?
Yes, it is. It is.
Thank you. Thank you. So let me give some Myanmar overview of a Myanmar agricultural sector along with Myanmar itself. So out of a total of 55 million population, in Myanmar, 37 million people, roughly 67% are living in rural areas. With 26% population under poverty line, Myanmar is considered one of the poorest countries in Southeast Asia. There are around 7 million smallholder farmers, farming families. One farming family can have close to 5 people, 5 members as a family. And 20% of the land is devoted to agriculture, which employs 70% of the population. Agriculture sector also contributes 29% of the country economy. What is the importance of agri-finance in Myanmar? Fairly basic question, but definitely we have to look at how we have to understand this agri-financing in Myanmar and then move into some kind of a solution if we have to. So basically, productivity in agriculture is directly related to supply of financial services. Low productivity leads to lower yields and definitely in return leads to lower profits for the farmers. There is a need for both agri and non-agri related financing for the farmers. Myanmar Agricultural Development Bank, MADB, is the largest provider for loans to farmers. And it's a government bank which is quite big in Myanmar, very old, which has taken up the responsibility to provide loans for a longer period to farmers. Informal channels are fairly expensive, which can be as expensive as a monthly interest cost of 7 to 10% for the farmers. There are a lot of constraints for farmers to take loan from the banks, as banks requires collateral. Just to mention that there are only 32% of farmers who have clear property title deeds. There is a huge demand for affordable financing by farmers. Let's look at the challenges in agri-financing in Myanmar. So investment, of course. There's a huge investment requirement for agri-finances, which actually has fairly low returns and longer period to get the capital back. The KYC documents are fairly limited. There is no information on credit history as far as lack of information asymmetries we talk about. There's a fairly high risk which attracts this investment, and therefore low returns is not very helpful. There is a fairly limited use of technology done by farmers, and the reach becomes limited with large land mass available in Myanmar. So overall, the 6 challenges what I'm putting up is not the only challenge, but these are the important ones, specifically the KYC documentation or lack of information with the financial institution or the credit history of the farmers. It makes it fairly worse situation and the biggest challenges to overcome. Let's move on to microfinance industry in Myanmar. So microfinance is a very, very highly regulated industry in Myanmar. Although the capital requirement is quite low as compared to other financial institutions, NBFC, it's kept at $200,000, and therefore there are 193 licenses issued already. Of course, most of them, about 60% is not used, but still there are 40% which is very actively used licenses in Myanmar. The total assets on the microfinance industry, just as information, is close to $1.5 billion. The top 20 microfinance companies hold 85% of these assets. Moving on to regulation, the maximum amount of loan is a local currency of 10 million, which is roughly $7,000. The interest is capped at 28%. It used to be 30% some time back, but now it's 28%. We hope that it still remains at 28%. There are talks to bring it down to 26 also. But an all-inclusive fees of 2% per annum is also chargeable by the microfinance companies to these borrowers. Of course, Myanmar is a developing country. There are no credit bureaus available. All these loans of 1.5 billion of market available has to be a non-collateralized, uncollateralized loan for the MFIs, which attributes to a fairly high risk in terms of the returns looking at that. The saving interest attributed is capped at 14% by the government. All borrowings, the last point is fairly essential and quite critical. All the borrowings which the MFI needs from the banking fraternity or the lenders has to go through approvals, all, be it the FRD, which is the Financial Regulatory Department, or the central bank approval. So the FRD is the regulator for MFIs, and the central bank has to have approval for all the international loans which the MFI takes from the international lenders. Having said that, each and every approval requires at least anywhere between 2 and 4 months for approval. So imagine the plight of a microfinance company, which has to consider each and every loan approval to be going through these bureaucratic system, which takes anywhere between 2 and 4 months. A bit about microfinance, Maha Agriculture Microfinance. Myanmar Oba Group and IFC are the shareholders in Maha. with IFC in minority, and OBA Group has a majority stakeholding. Maha provides 100% rural loans, offering 4 products: agricultural loan, MSME, vendors, and livestock in 9 regions with 37 branches, currently serving 80,000 farming families. Maha also follows, follows individual loan lending model and has 99% of the portfolio as agricultural loans, employing 300 people with 61% women. In a nutshell, on the right side of your screen, you can see Maha offers a loan with 37 branches in 35 townships, 9 regions, covering 31 crops in 3 seasons. We just celebrated our 8th anniversary yesterday, so it was quite a pleasure to look at how these 8 years have gone by. Let me also run through company timeline a little bit. Launched in 2013, 9th of August 2013, as in yesterday, by Myanmar OBA Group. It opened 15 branches by 2016. We received IFC investment of $1.5 million as equity in 2017, and also set up a board of directors as a requirement to get that financing. 2018 saw a fairly good change. We had full corporate governance structure, and our first impact assessment report came out. 2019 was a year of growth. We had 3x in GLP, 2x in number of farmers, and an ever-growing company which it looked at. 2020 was another classic year when we had Smart Campaign certification and performed our first social rating. Along with COVID, 21 came up with political uncertainties in Myanmar. I'm sure you guys are aware how these political uncertainties are impacting the lives of Myanmar along with the business as well. My assumption is 22 will also be linked with political uncertainties, but we will see how things are and how it goes. Proposition on Myanmar of Maha. So there are currently only 5 MFIs doing agri financing, agri loans in Myanmar, and Maha is the only one which is distributing individual loans. The others are doing group lending methodology, which Maha is not adopting. Our approach is very, very customer centric, and hence there are products which are tailor-made for the needs of the farmers. Maha leverages extensively on the use of technology. With OBA having 26 years old history, understanding agribusiness and financing, I would say we have very deep experience in the whole financing and agribusiness. We drive financial inclusion for unbanked population, which is estimated at close to 35 million in Myanmar as of today. And of course, the focus on social development goals established by UN are again one of the fairly big criteria for Maha. It's been a successful tenure of 8 years of Maha, and I would, if I have to pick up top, I would pick up these 4 success drivers: corporate governance frameworks, social performance, human resource, and policies and procedures. So looking at the corporate governance plan, we have a full range of corporate governance measures in a small company like Maha. There's a board of directors, there is audit and risk committee, there is a remuneration and nomination committee, there is asset liability committee, and all these meet on a very, very regular basis. ARC and ALCO have also independent chairperson for heading these committees. IRMC, Integrated Risk Management, meets every fortnight, and XCOM is a weekly affair. Grievance committee is set up primarily to look at the grievances of the staff, and that's met on a fairly need-based basis. If I look at the social performance, that's a very different one to look at from a financing point of view. And not many of the companies, especially the microfinance companies, do not focus on social performance basis. We look at sustainable development measures of 1, no poverty, 2, zero hunger, 12, responsible consumption and production, and 14, life below water as focus areas for us at Maha currently. It's been 3 years we've been following these development SDGs and see how it goes. We published annual impact assessment reports. The 3rd one was published in May 21, and we have regular green initiatives which contribute to our success. Human resource is very, very powerful. We don't have anything else except human beings and of course, financial power to look at. And it's a very performance-driven culture at Maha. With gender diversity, as I mentioned, we have 61% of women working and a very low attrition rate. We also have very, very strong internal control policies, integrated risk management approach, and a robust scoring mechanism. That's a very interesting one to look at, as Maha follows triple bottom line approach to performance. What is exactly a triple bottom line approach? We have financial performance, we measure social performance, and also measuring environmental performance. I'm sure everybody is aware of the financial performance, which is strictly basis P&L, the figures and the numbers. However, social and environmental performance bottom line is very different from Maha, and here is what we do for them. From a social performance measuring point of view, we have a performance on the social outcome, and therefore on the bottom line of Maha, it is considered the outreach. With the outreach of 73% of the clients below $2.5 a day, or 10% and 10% of the clients below $1.25 a day, the outcome has been really, really encouraging. We have managed to increase price per acre revenue by 62%, around $100 in a monthly expenditure per capita over a 3 loan cycle for our farmers. This has been fairly unique in measuring our performance, and some of the impact investors and DFIs like FMO, EDFI really value these measures. We also measure environmental performance, and that's again a very unique one to Maha, which not too many companies focus on. Screening of loans is fairly important. All the loans, all the clients are checked against IFC exclusion list because IFC is a shareholder on the types of crop, what is being offered, the 31 crops, what we offer. Is that listed in that crop? If not, we definitely do not get into excluded list from an IFC perspective. At each distribution, our clients are given training about sustainability, environmental practices, use of pesticides and fertilizers, and of course, deforestation. There is a sustainability effort at the office, which starts with recycling initiatives and mangrove planting. Again, mangrove planting comes under this SDG 14 from a UN perspective. What is the current business model of Maha? Against the traditional lending methodology, Maha has a fair amount of use of technology in business model. From application to registration, to core banking uploads, to credit scoring, to monitoring of loans, everything is digitized with the use of tablets and so human intervention is fairly low, including the monitoring. What we do on the loans are done on real-time power monitoring basis, which is again quite effective for us, at least at a Maha level, to be looked at. We have a hub and spoke model. It's not that we are completely digitized, and we reach deep rural areas with 37 branches all over the country. Maha is, by the way, the highest average ticket size for agri loans in Myanmar. We are number 10 on the top 10 microfinance companies in terms of GLP. With extensive technology use, our average turnaround time is 48 hours to provide a loan. Fintech. I mean, there is this always a new talk about fintech to figure out how fintech works, how fintech does, what is the impact of fintech. But I believe fintech has a different understanding for different people. We at Maha focus on clients' needs to adopt fintech and digital benefits to our customer needs. Be it faster access, turnaround time, for example, increased customer centricity, tailor-made loans, digitized process reduces times, efficiency increases, lesser errors, reduced cost. And of course, we have, last but not the least, we have the shorter forms of client satisfaction, what we get to measure our customer services provided to our customers. Okay, so what's the vision for Maha business model? Now, we recognize that the need of the hour is to serve 1 million farming families by 2030, and in Myanmar, from 80,000 farming families today. Maha is undergoing Maha 2.0 model, with innovative cashless and AI-driven business model, which will complement the existing models. It's not overriding the hub and spoke model what we have, but it'll be a complement to that whole thing. For data-driven credit decision-making or robust front and back-end system, we definitely are looking at partnership with fintech companies who can provide us support here. And we are in talks with a few. Maha plans to be on this ongoing focus, and there are very several initiatives what we are trying to put together, which I'll share with you in my next slides. Okay, so these are, there are 7 initiatives what we are considering to look at reaching a 1 million farming family target by 2030. One of them, and these are not in the order of priorities, but everything is important, but we just put up in terms of our requirements based. So we're looking at leveraging a cloud-based core banking system, which is quite robust backend and front-end system for us. We're looking at building a data platform to use business intelligence dashboards with a significant data points in absence of a credit bureau, what we do not have. We believe we can definitely get eKYC for clients, so facial recognition, etc. And hence a digital KYC verification is a must. We cannot do without it. We have something like a biometric system today. I think we really want to make it more robust by preventing frauds and using facial recognition as part of our evaluation. We look at scorecard-based credit scoring model to leverage alternate source of data. We're moving away. We want to move away from cash to cashless models using digital e-repayments. We are trying to use satellite imagery-based decision intelligence. I heard SatSure name coming up, and we are definitely in talks with SatSure to figure out how can we use satellite data for our business and credit decision making. The last one is also fairly interesting. We're looking at integration of MFI platform, which can help us to look at what kind of available information for our borrowers, the farmers has, and try and prevent over leveraging of the farmers by trying to look at the data, integrated data for all the MFIs put together. Challenges. I mean, I would say apart from operational challenges, which are ongoing in nature, which I've already highlighted in my earlier slides, on the left side of your screen, you can see that. But I would rather touch on the current and more recent ones. So Myanmar is facing, I believe, one of the most tough times with political turmoil and economic issues. I'm sure most of you are aware that of the political uncertainties faced by Myanmar as on February 121, when the military junta has taken over the democratic elected government. Well, started with disruption in banking operations for 6 to 8 weeks, which means there were no banking operations at all, and all the banking operations were halted for these 6 to 8 weeks. This has created a very low confidence with international lenders. And all the talks of additional funding has gone for a toss completely for now. There is a big cash shortage in the market, be it US dollar, be it the local currency. Everybody wants to hoard money. There is a big corporate houses hoarding money in order to keep their businesses alive, for example. But there's a huge depreciation of dollars by 25% effective between January and now already. And there are a huge risk of cash carrying, which is driven by these political uncertainties. As per one of the recent World Bank report, Myanmar economy is actually expected to contract by 18%. I mean, on top of this, there's a weak economy, weak growth already, which means the economy will get smaller as per the report by 30%. The impact of this, I'm sure, is immense, and in my opinion, will be very long lasting. I'm still not touching the COVID reasons because most of the countries are facing the COVID reasons. Myanmar is just on the verge of the third wave of COVID, and there has been a 4-week closure for the whole country now. My last slide is fairly interesting and food for thought. And is agri-finance in Myanmar to be considered a challenge or an opportunity? We still don't know. We still have to see. And I leave you with this thought. Deepak, thank you very much once again.
Thanks a lot. Really appreciate the great presentation. And I know times are tough in Myanmar, and a perspective from Myanmar is very welcome. And I hope and believe that soon the challenges would be over and Myanmar would again become the beautiful country which I visited a couple of years back. Thanks a lot.
Deepak, it's still beautiful, but I think it's more of a perception change from a darling of the Southeast Asia, and now it's becoming a scary country where travel becomes a fairly nasty affair. The visa approvals take never-ending timelines, etc. So it is still I would say, a beautiful, humble country and people. But yeah, it's changing, and we still need to figure out, as I said, whether it's an opportunity or a challenge. We don't know yet.
No, I'm having a double risk. Actually, I was interacting very closely with Her Excellency Aung San Suu Kyi's, her office, right? And I believe, like, if that mail is being tracked somewhere, then I might not be very welcome person there. Thanks. With that, I thank you. And because of paucity of time, we won't be able to take questions for you, sir. We go to our next speaker. And I again thank you. And I wish people of Myanmar to have safe and I'll say that prosperous future. Thank you.
Thank you, Deepak. But questions, if you can send it to me, and I can definitely look at answering these questions.
I'll do that 100%. We are having a few questions.
Deepak, and thank you. Thank you, everybody, for listening.
Yes, sure. So now we are having our next speaker, Dr. Venkatachalam Shunmugam. Dr. Shunmugam is the consultant for National Institute of Security Market. He has rich experience in global policy analysis as connected to trade, market and market institutions and developmental economics research. He has worked in close coordination with policymakers and market regulators and is known for foreseeing and formulating policy changes for its impending impact on larger business environment. He had extensively written on market reforms, recently in various media for spot commodity markets in terms of enabling institutional support. He has been a national thought leader and trained macroeconomist with a wealth of network across ranks and files in government, regulators, business academics, and expertise in dealing with multiple regulators, markets, products, with experience in strategic communication to the stakeholders. The floor is yours, sir.
Thank you, Deepak. Thanks for the invitation from, how would I pronounce, HnyB or?
It's HnyB, sir. It's
HnyB. HnyB, yeah. Okay, HnyB. It's a short form of honey. Okay, sorry. Thanks for that invitation from HnyB side. I think, we should be active as like a honeybee in terms of searching for knowledge. So it's a right sort of a forum for me to share my perspective. So as you had rightly, hope you are able to see the presentation, which I attached a small presentation. Okay.
Yes, we can.
So as you had rightly, put together the, my profile actually. So I had started my career with the foreign agency called the U.S. Department of Agriculture actually. So that agency, as you all know, is one of the agency other than the Food and Agriculture Organization of the UN, which used to collect, which is still collecting the information of the current information about the production, supply, distribution of Indian crops, and many of the major countries which are predominant in agricultural trade across the world, and putting together those numbers and predicting those numbers for the next year and things like that. And I used to remember, so that's one of the numbers that people in the market used to look at maybe at 5 o'clock after the market stops or something, they used to look at in terms of taking positions in the market. So, so at that particular point in time, so I started my career with USDA maybe in 1996. And then I kind of moved on to commodity exchange, which is MCX actually, which is another, a new initiative from the government of India side, which came in basically because, India was joining the World Trade Organization as a full-fledged member, actually. So, so going back to the USDA times, actually, so at one point in time, we used to fight out for the aid to come in. So to say that, like, at some points in time, CARE, the agency which was actually importing the the wheat flour and corn flour and the soybean oil came to us saying that hey, here it is. The problem is, they say that your soybean oil is modified, genetically modified soybean, produced from genetically modified soybean. So we will not be able to give you a certificate because our laws explicitly prohibit import of any genetically modified material. So at that particular point in time, the point that I wanted to say is we were highly dependent on food aid in terms of, making food available to the last mile in terms of removing poverty and hunger in line with the topic that HnyB had rightly chosen actually. So we moved in from a food aid dependent economy into an agricultural export oriented economy, wherein last year we had clocked the topmost level of agricultural exports in terms of value, which is about 41.25 billion actually. So I myself had been a critic of the system that brought me out, which is the agricultural research system actually. But if I look back where we were in 1996 and where we are, where we were lingering around 190 million metric tons and things like that. Now we are around 305 million metric tons, and which is much, much more than what we need to feed our population. So that gives us an opportunity, but that's also a problem of plenty. So anyway, the world is in need of food grain, so we are able to export it actually. But we really have to think back and see whether we need that much amount of food grains. This is one of the challenges that the growth in productivity of the food grains has posed now. So the other thing that if I want to quote is that we used to have American Soybean Association representing the American soybean farmers, to work in the country. And typically they have been training all the soya products manufacturers into what types of soya products can be produced. So I just, interested in finding out what is that US getting out of training the Indian soya producers. What they are getting out of training Indian soya producers is making India to consume soybean meal on its own rather than exporting it to the countries to which US is actually also exporting actually. So that's another area where, we moved on from a soya meal exporter into a country which today is talking about importing soy meal so that the poultry meal can be much cheaper. So a lot of transformation had happened in the last 1 year or 2 years actually, but end of the day, the farmer's income have remained the same. The food processing as an activity had remained more or less, a low margin activity, not a very attractive activity. So these being there, the main problem had been that the funding, the financing of agriculture has been the problem. So that's the core topic of today's, the session that we have been attending actually. So the growth has been more in the food grains, as you had seen. Oil seeds are low in terms of domestic production. On the other hand, if you see, we need more of oil seeds. We are too much dependent on edible oils actually. So we are paying out of around $41 billion that we are exporting, around $13 to $14 billion we are spending on importing edible oils actually. So the net to net imports after deducting for vegetable oil imports is just around $25-26 billion actually. So that means a lot of what we export, we are eating it again into it actually. The other thing is that inefficient value chain. I mean, why the farmers, why the agricultural processors are affected by low margins of whatever that they produce and things like that. Inefficient value chain, and that inefficiency is coming because of the higher cost of capital actually, one, and second is the market transparency. And market transparency is very important aspect of markets, basically because if there is no market transparency, we can see that prices in the producing centers were going down, but the prices in the consumption centers were going up. For what reason? No reason. Just because the people in the consumption centers do not know what is the prices that are going on in the the production centers actually. So that's another important part of the inefficient value chain. And in order to remove that, your futures markets have come in, and futures markets have enabled, increased market transparency, and that has, led to risk management opportunities and things like that. So that's an important aspect. But unfortunately, we couldn't see the development of the futures markets in the broader commodities, such as wheat, rice. Rice is anyway banned. Wheat, or let's say chana, or any of the pulses that we are deficient in, we don't see that kind of a growth over there actually in terms of the futures markets trading volume. So silently over the last I would say 1.5 decade, there is another phenomenon that is happening, but not moved anywhere else, is the warehouse development and regulatory authority. So which is like an authority which authorizes scientific storage facilities which are being operated by public or private investors, and those are authorized for issuing electronic negotiable warehouse receipts. So that brought commodities to an entirely different sort of a paradigm, where commodities can become safer commodities on which financing can be done. So we'll talk about it at a later point in time. So that is another important thing which has been happening in the last 10 to 15 years. Another important development that has happened in the Indian agriculture market is the food processing industry has been growing over the years actually, and not only that, it has brought all the modern products into the market. It also brought the traditional products like millets and things like that into the market. So that's another thing which has been happening slowly in the last 10 years. And because of the COVID-19 impact, that we could see that a lot of households are consuming the processed foods rather than going to the restaurants or things like that, largely because they are closed, or more because people are caught up at home and they would want to consume food based at home actually. So that's another phenomenon that is happening despite the lower margin that you have for the food processing industry. And the third aspect is information for markets. So, for example, the point that I just wanted to say, that when I started my career with the US Department of Agriculture, when we put our numbers for oil seeds and food grains, and which includes your rice, wheat, and pulses and things like that, media used to look at those numbers pretty much more, attentively, rather than the numbers which are being put up by the government of India. So those numbers, unfortunately, we could do that, or we could do an update on a monthly basis after talking to all the businesses, after touring over the major growing areas, after meeting with the industry people. So this is the way that we collect and post the information. So, but we don't do it on a periodical basis, but we do it maybe on a quarterly, maybe on a semi-annually annual basis in terms of changing those numbers. But if you look at developed markets, where the pricing has helped develop a lot of market transparency, this information is collected in a frequent manner, either in terms of institutions which are at the ground level, or using the latest technology, which is satellite-based technology, using those, what's the kind of sowing which is happening, what's the state of the crop in most of the sown lands and things like that actually. So that's another development that had happened over a period in time. But unfortunately, we at India, we had neither used the ground level strength, which is our local bodies at the ground levels, nor have we used the satellite technology that has been available in terms of collecting information on sowing progress, the state of the crop, and things like that. So those are still lagging at on the other hand, actually. So on the back of it, the derivative market, which is supposed to converge this information, also had been lagging in terms of their strength and supporting broader commodities, actually. But on the other hand, if you look at the commodity derivative market, there are successful commodities which one can claim, which is guar gum, menthol, or cardamom, which really made that impact on the growers of these commodities in terms of delivering better prices to them, shrinking the value chain, and increasing the market transparency, and connecting the world of finance with this one. And Another one is reducing policy intervention. And thanks to the current government, which actually looked into this in a very serious manner, liberalized, the market platforms. It is not necessary that the farmers have to access the, APMC platforms. They can go to any and every available opportunity from a trader, from a e-marketplace. They can go there and sell their products. So that's another development which had happened. And they also at the same time silently abolished the Essential Commodities Act. But there's, recently they took a back step, but that's not a big back step that I would say that actually. That is to say that if you store more than 500 tons of any of the pulses because the prices were going, we need to know. So I'll come back to it. How this can be effectively solved in the coming slides actually. And quality standards, lack of user orientation. So for example, there are multiple standards. You have an FSSAI standard, which is more from an food safety perspective. You have an AgMark standard, which is more from a the quality perspective and the storability perspective and things like that, not from a user perspective. At the same time, if you look at the US, the entire corn is actually divided into 3 types. One, the corn which is going in for food industry or food processing industry. Number 2, corn number 2 is the corn which is going in for the feed industry, and corn number 3 is the corn which is going in for industrial purposes, which includes your ethanol and other alcohol production techniques actually, and even corn sugar. So there are like 3 or 4 simple standards which exist for dividing the entire universe of the crop production actually. So today we don't have that sort of a mechanism, but if we have that, then we have a clear view of this is our human consumption, this is our feed consumption, and this is what is our production, and this is what the price should be. So even the lack of quality standards or the orientation towards what the users need, either as a feed producer or an industrial user or a food manufacturer, it should be of 3 or 4 types. So that'll get in some more clarity on the prices, which is currently lagging in many of the derivative markets actually. Okay, so in the absence of all this, agriculture markets have traditionally been dependent on the local borrowers and the local lenders, and also the microfinance and the bankers and things like that actually. And that's based on some compulsion that existed among the bankers that they have to lend a particular percentage of their lending towards the private sector, and one of the private sectors is agriculture commodities. And it actually resulted in some lending which is getting into agriculture market, but largely farmers were dependent on the local level money lenders who charged usurious rates. In turn, they captured the commodities, and that led to a lower price realization by the farmers and things like that. But over a period in time, that the phenomenon of WDRA and the concept of the warehouse receipts happened to be one of the attractive things where the banks were ready to lend against actually. So that made an attractive opportunity for the farmers or the farmer producer organizations or the warehousemen are the corporates who are owning those, the commodities to store it in a warehouse, which is managed by a collateral manager, and the collateral manager works with the lender to ensure that the goods are safe, secure, and they are quality tested. And for the given quality at the today's market condition, this is the value of the total commodity that you have lent against actually, and your haircuts are much safer actually. So they did the quality collateral management for the banks actually. So it made an excellent model for the banks to lend against the warehouse receipts. But unfortunately, what had happened was the growth of scientific warehousing under the the WDRA regime more or less remained the same in the last 3 to 4 years, actually. And it also didn't pick up so aggressively in the last 10 to 15 years. So which is just about, single digit numbers in terms of the total warehousing capacity that is available and the WDRA accredited warehousing capacity, actually. So that's again a big constraint, which today we are faced with, because of which this as an activity, agriculture financing as an activity, could not go any further, or the commodity financing as an activity could not go any further, actually. So the point that that I just wanted to say is that it has a huge potential to lend against commodities, and that will solve many of the problems that we are today facing, actually. So imagine a condition where all of our 300 tons of food grains, or 4.7 million bales of cotton, or 31 million metric tons of sugar are getting into a warehouse, and warehouse receipts are issued against, and everybody knows who's holding what, or something. We know that how much of that is under storage at any particular point in time, and the market knows it. This is the total production, this is total storage, and this is going to be our consumption, and this is what the price is likely to be. So it helps everywhere in terms of markets to lenders, in terms of financing those commodities and things like that. So total, even in terms of with the public warehouses and the regulated warehousing capacity, we have potential to lend about 2 lakh crores, which is more than the limit that the public sector banks have against, actually. And as against that, approximately there are about 40,000 to 50,000 crores are being lent by the banks, and last year it came down to 25,000 crores, actually. And that came down to 25,000 crores because the banks who lent against commodities met with frauds. And that's what exactly that I just wanted to put it before you, that you as community who belong to the technical side of how different problems can be mitigated using technology, can come up with solutions which can actually further deepen lending against commodities, actually. So that's another thing that we have. Okay, so what is the scope, actually? So the scope is we have to have scientific management of warehouses. Scientific management of warehouses, saying that warehouses have to be designed and operated in such a manner that it needs very less manual intervention. Almost all of the processes are automated, at least for that matter. Less manual intervention is what that I would say that, actually. So when we talk about less manual intervention, if somebody has to know, the lender has to know at what is the humidity level that my commodity is being stored, because my commodity is prone to spoilage under a high humidity level. An IoT device which is kept in the warehouse actually will transmit that on an online basis to the lender, saying that, hey, your humidity level is increasing, so please ask your collateral manager or the warehouse manager to make efforts to actually to mop up that humidity using dehumidifiers and things like that, actually. So that's one which is in terms of scientific management. Another one is how to prevent warehousemen colluding with the borrower of the commodity to actually move some of the commodities out of the warehouse. So I would have a digital lock, I would have a monitoring and surveillance, real-time monitoring and surveillance, and alerts can be generated using real-time monitoring and surveillance activities that could be done. Geofencing, which is like using satellite, are there any activity which is happening around the warehouse that is, that I have lent against? This can happen only if, you have the entire warehouse to which you have lent against and things like that. And another phenomenon which has happened, but had not taken, basically not because that is not a failure activity, just because that the warehouses which are registered in the WDRA regime are almost like stagnant, is electronic repositories. So electronic repositories enable the warehouses which are accredited by WDRA to issue electronic negotiable warehouse receipts. And these electronic negotiable warehouse receipts are assured by WDRA in terms of performance of the commodities and scientific storage of the commodities. And in case of any financial risk, that will be mitigated, actually. But End of the day, the lack of awareness and the lack of proper arbitration mechanism that made banks to be a little wary about even the ENWRs actually. So it's currently happening because WDRA of late had woken up to these problems of the financial risk management and things like that, and it is being worked out actually. And another third or the third aspect of the problem is I have to, from a time to time, I have to look at what's the kind of value that my commodities had been fetching, which is if we have an app-based valuation, wherein that this is your amount of commodity based on the nearby market, this is the price that I would be getting, and so thereby I as a banker, if I have lent out of 100 rupees of the value, I have to maintain 35 or 40% as the haircut. I will be able to manage, if not on a real-time basis, on a day-to-day basis or on a week-to-week basis, so that my risk is pretty well covered. So if there is an app-based valuation, that will help. And at the same time, this app, if it can connect that to an electronic marketplace, if in case of default or not being able to pay enough of margins, the lender can dispose of the commodities, which is actually posing risks to him in terms of his credit which you have lent to him actually. So easy disposal is another problem for many of the bankers actually, which can be done away by the electronic marketplaces that has come. So imagine a situation, you are lending to the commodity which is worth about 100 rupees and you are giving them only 60 rupees just because you don't know after 6 months what is the price of that commodity. You know what is the price of the commodity and you assured what is the price of that commodity after 4 months, because this person had gone and hedged his exposure, let's say at 90 rupees actually. So, and he's going to get that 90 rupees out of the futures market for sure actually. So you'll be happy to lend it against that particular commodity to the extent of 80 rupees. So out of 90 rupees, which is the value, you just take about 12%, 13% of the total value, and then you lend to them to the extent of 80 rupees out of that 90 rupees, the value that is coming out of that. That is basically because he had hedged his exposure in the market. So, or otherwise, if the bankers are allowed to hedge in the market, which is today not allowed, the bankers can take participation in the markets and hedge their exposure, and that way they can maintain a minimum haircut and make lending against commodities a much attractive proposition actually. Blockchain is another phenomenon that is coming in, which is actually ensuring the ownership, the transaction in the commodity pretty much visible across the user ecosystem and things like that, is making its debut in terms of connecting itself to the warehouse and warehouse managers, but also is connecting in a smaller manner to the people who are into commodity financing. Another important aspect is quality testing and certification. So oftentimes, that's a big constraint in terms of I as a lender, if I go to a warehouse to which I have lent on, I don't have information about what is the quality that is currently the soybean or the corn that I have stored in over there. So if there are random testing or random and rapid testing facilities that are available, then I would be much more comfortable. Rather, if those are facilities which can be managed by a field level person and he can transmit the information to a risk management team which is centrally located, that is the best model actually. So those are technologies which are currently under development and under implementation, but I really wish that those are things which can come up on a rapid manner in terms of random assessment, and they provide rapidity in terms of testing and also accuracy as good as the traditional methods of testing those commodities actually. So moving forward, what are the challenges that we need to do? So we need to have strong and robust agriculture commodity derivative markets where they become the efficient price signalers actually, so that the farmers know how much to sow. If I have paddy sowing, which I decided to do that, and that's going to give me a price which is 10% lower than the cost of my production, or 10% lower than what I am expecting as the price that I should. So I should stop, deciding on sowing paddy. Rather, I should look at another crop which is equivalent to paddy, which I can grow in that particular land, depending on the water. Obviously, there are other factors which decide which crop that you can in a particular field, but there are always alternatives which you can grow, which can give you a better price. So in order to give you the better price signal, you have to have a broadly participated and deeply participated agriculture commodity derivative market. And today, which is lacking, that is lacking because of the information flow, which is very weak in terms of collection, dissemination, and the convergence of that information into the markets, actually. So today that is pretty weak, and that is why you don't see markets, having volumes beyond 3 to 4 months. That means, at the time of, harvest, if you want to hedge your commodity while you are sowing your commodity, you don't have liquidity in the harvest time contract, actually. So you won't be able to hedge your exposure. So maybe moving 1 month forward after you have sown the crop, you'll be able to do that, actually. Another thing, a key and important decision which is pending because of the policy making is banks should be connected to the derivative markets. Banks being connected to the derivative market, they are the people who can make this collection, dissemination, and convergence a robust process in terms of information flow convergence, and also creating liquidity in the 4-month contracts, actually, so that the hedgers can participate in those contracts and benefit from their participation, or the farmers can benefit from their participation, the corporates can benefit from their participation. End of the day, the banks can also hedge those exposure that they have on their lending against the agriculture commodities by hedging their exposure in the agriculture commodity derivative market, so that their balance sheet is free of any of the credit default risks, or which is arising out of the price volatility that is there in the market, actually. And another silent revolution in a way that is happening is FPOs, the farmer producer organizations, that has been growing in numbers in terms of and also in terms of the crops and the geography, actually. Yet there are only 7,500 FPOs, around 7,500 FPOs who are either registered in terms of a cooperative or a corporate, and they don't have a way by which collectively they can function. They don't have an accounting methodology. They don't have access to finance, and they are marred with several difficulties. And one of the key difficulties is access to finance. And one of the key solutions that it can be quickly delivered over there is FPOs can actually pledge their commodities which their farmer members are bringing into to store, and in turn lend to those farmer members and hold the commodities and sell it at a later point in time, and use the capital basically to do various other activities in terms of purchasing seeds and fertilizers and other agricultural inputs and distributing to the farmers, actually. So in terms of the coverage, the FPOs are pretty concentrated on 4 or 5 states, which is Uttar Pradesh, Maharashtra, Tamil Nadu, Telangana, and Odisha. So these are 4 or 5 large states which have about 60 to 70% of the total FPOs which are covered, actually. So we need to move further level up in terms of FPOs, in terms of making FPOs as momentum into themselves. The other important thing that I told you about is the simple but effective quality standards, which actually increases testing, increases efficiency of the storage and funding against those commodities and things like that, actually. And those effective quality standards should only have usage-oriented tolerance levels, actually. So I, as a corn oil or corn-based ethanol producer, I am least bothered about the protein level in the corn. So there should not be any protein level assessment for corn number 3, which is being used for corn sugar production or ethanol production. So this is something which is lacking. So we have a very generic standard, but generic standard doesn't go anywhere, because I, as a user, need a particular grain which is of that particular type. And we need to expand the coverage of regulated scientific warehousing capacity. Some of that is lacking, and extending credit against commodities to large corporates. And it is a welcome move that RBI has actually extended the credit limit on commodities that are being lent to large borrowers to about 75 lakh rupees. But when we talk about the large corporates, even this medium enterprises and processing sector, they may have crores and crores of commodities which are stored actually. After all, end of the day, it is this price volatility which is actually getting reflected at the consumer price index, which is inflation. So if it is managed by extending credit at the priority sector lending rate to large corporates, nothing harm against, because it doesn't add up to the food price risk. And this is what is actually happening in many of the developed countries, and which we need to move on towards adopting actually. And the other aspect is the collateral management industry, which is the mediator between the borrower and the lender, has to be regulated. Because of the lack of regulation, this is another big gap which is actually making the banks to lose interest in lending against commodities, which is otherwise it is a 2 lakh crore opportunity. And think about you people who can provide technology solutions. Out of that 2 lakh crores, even if you capture about 1% of the total value actually, so that's a big amount for you to capture. And this can be done if you can provide cost-effective solutions in terms of technology for various challenges which are faced by the lenders and also the collateral management industry. And one of the key solutions is insurance solution against fidelity risk. Fidelity risk is, the warehousemen colluding with the borrower and let the commodities to be stolen. And when the lender sees that the borrower had defaulted and he wants to dispose of the commodity is no longer in the warehouse actually. And the insurance guy, when he goes to the insurance guy, say that, my commodities have been stolen. Did you follow my protocol? Did you launch a police complaint? What is the finding that you've done? So oftentimes this insurance is, reminding us something which I can't get it at all actually. So that's the experience that I've seen in many of the banks actually, that they are not much interested in coming with an insurance solution, basically because insurance, bring in one, a very high premium, or two, so many impediments to getting that money back actually. So if it is actually aided by a technology-based solution, that would be something which I think both bankers and the insurance would be happy to look at actually. And the other one which I, associated with NISM, we are working on is developing professional skill sets in scientific warehousing, including commodity credit actually, which is something of, a skill enhancement, thing that we have taken in warehousing, which will include modern developments in warehousing, which is use of information and communication technology in warehousing actually. So that's about it. So you as people who are involved in, lending against commodities, are, providing technology solutions, you will be, happy to, talk to me. I'll be happy to take any questions. I don't know whether I have actually exceeded my time limit, Deepak. I'll be happy to, or, if you receive any questions, you can be, feel free to forward it to me. I'll be happy to address that and things like that. Thank you.
Sure, sir. Actually, it was very insightful presentation. So that's why, we have short on time, but it was so insightful. I didn't want to disturb you because it was, I'll say that pure nugget of insights from the practitioner who has been there, done it. So very insightful presentation, sir. I really appreciate your time and effort in putting all these very important points, because generally when we talk about agricultural finance, we just hop around funding farmer. We just tend to forget that there are so many different, I'll say that, moving parts which can still be used and make the system more efficient. And the farmer's problem we can always solve, when the appropriate time is there. It was pleasure to have you, sir. Thanks a lot.
Thank you, Deepak. Thank you.
So guys, with that, we come to the end of this another very insightful roundtable on agriculture. And today we delved into a very important topic, which was agriculture finance. Our takeaway from this session or this roundtable is that agriculture finance while risky, but it is very critical for a country like India and all the other developing countries where agriculture contributes at least 15 to 20% of their GDP and between 25 to 50% of their population or working population is involved in agriculture. Finance is a very critical aspect of any industry, and for agriculture, it becomes more important because those who are doing the actual paid work are the farmers. And unfortunately, they are not as privileged as many of our entrepreneurs and industrialists. With that, I thank all my speakers and panelists for sharing their insight and views on how to make agriculture financing more robust and more effective. Thank you. And we look forward to again have you and host you for our next agriculture roundtable, which will be focused around market linkages and market access and how technologies, including those in traceability, are impacting the overall ecosystem and making access to the produce from the farmers more lucrative for the consumer, at the same time also creating more value for the farmers. Thanks again. Good evening. Good night. Take care.